Hey, welcome back to those of you who have signed up to my other courses. Welcome back or welcome to another course. So this course is going to be about technical analysis. So this is a crash course on technical analysis 101. I am going to include so much information and valuable details about your technical analysis, how to do your technical analysis. Now, so basically in trading, there's three main parts to trading. There's technical analysis, fundamental analysis, and sentiment analysis. If you get all these three right and your timing's right, then you're going to profit, much more likely to profit. So if you want your fundamental and sentiment analysis, I have other courses. There's many other courses which I teach that, but this course is going to be purely focused on technical analysis. Now in this course, I'm going to teach you in detail how to use more than 20 different indicators. And so instead of saying this is the way how I trade, these are the indicators I use it this way. Every trade is a little bit different. There are indicators that are lagging, there are indicators that are leading, and there are sort of indicators which are better for swings. There are indicators that are better for scalps, or everything. So it's a little bit different. So in this course, I thought I'd share with you all, like, more than 20 indicators and 20 different strategies and how you would use them. And I will show you indicators on both the MT4 platform as well as TradingView, which are the two that I mainly use. And I'll show you indicators across every financial instrument, so you can then, after this course, in terms of technical analysis, you're ready to trade stocks, options, cryptos, CFDs, forex, futures, ETFs, or whatever you wish, using on a technical basis anyway. So yeah, you can use all the indicators in whichever way you prefer, and I'll show you them all in this course, throughout this course. So there's a lot of value here. I believe this course, if you sign up for and do it, there's something that anyone can learn, and there's so much value I believe this course can provide. And I also include my Freedom Income Discord group, sign up link as a part of it, which is free, by the way, and we have a high win rate, about 85% I would say, across all financial instruments. And we're also quite good at anticipating market crashes or corrections before they come, so saving you the money and having a lot of capital available in order to buy the bargains on the way up, which is like pretty much what's happening right now. So do check it out if you like the sound of that. Thank you. Happy trading. Hey guys, welcome back, and thank you for signing up to the course. I believe you find a lot of value throughout this course on a technical basis, from a technical analysis basis. I'm really going to teach you guys a lot about technical analysis, which is actually one of the key, I would actually say probably the most important type of analysis to do, although fundamentals is very important too. But arguably fundamentals and technicals are both equally as important. But basically there's three main parts: fundamentals, technicals, and sentiments. If you get those three right, you're pretty much onto a winner here. So I was thinking, first of all, throughout the course, there's going to be links like TradingView. Sign up to TradingView, the link to TradingView, MT4, or what platform to trade stocks, or what platform or recommended platform to trade forex and CFDs, and recommended platforms for cryptos. I'm going to include those links throughout the course. I've been using those links personally for years, and I've tested them. I've tried a lot of different platforms and different brokers, and the ones that I provide in this course are the ones, in my opinion, are the best. You can do your own due diligence as well. Again, I'm not a financial advisor, so don't follow blindly. Do your own DD and do your own research as well. But I try my best to help and be as honest as I can in terms of guiding you guys to successful trading and investing, based on knowledge and experience, and based on success and achievements as well, actually, in the trading arena. So yeah, so I was also thinking this course I'll lay it out in such a way so that each video I'll teach you three different separate indicators, because I don't want to make it one course teaching you like 25 indicators in one video, which takes 2 hours. I'll separate it in about 10 or 15 minute sessions. Each one will teach you three different indicators, and each title throughout the course, each section, each title will actually have the indicator name there, so you know which one's teaching what. And again, I'm teaching you all of this so that you can then go out there and use them in your own way, because everybody trades a little bit differently, and you might like scalping, or somebody else might like swinging, and which one to use what, all that stuff. So yeah. So that's basically that. So 3 indicators per session. We'll run this until we get to the end of it, which is just a lot of value here. So thank you guys and enjoy the course. So this video, just in case some of you are perhaps beginners out there, I wanted to mention about the platforms. So one technical analysis platform which I use extensively, and I've been using extensively for years now, is TradingView, right? So this is TradingView right here, TradingView.com. So this is really good for technical analysis for anything. It's got pretty much all financial instruments, whether it's cryptos, or stocks, or forex, CFDs, anything that you want, like US 500, VIX. That you can do all your analysis here for your technical analysis via this platform, which is TradingView. I'll include a link in the description area of this chapter, and should you wish, you can sign up. So TradingView, they have different packages. They have a basic package which is completely free, but that one's limited to 3 indicators only, and only one watch list. And then they have a next version, which is the pro version, which is limited to 5 indicators, I think, with 3 watch lists or something. And then you got Pro Plus, which is like, I think, 10 or unlimited watch list and 10 indicators. So the Pro Plus allows you to have 10 indicators, which is the version that I am on. I'm on 10 indicators. I find that's quite effective for me. I kind of need quite a few indicators. I find just 2 or 3 is not enough for me, because I trade all financial instruments like pretty much on a full-time basis, ongoing. So I find I do need these indicators. The Pro Plus version costs, I think, about £25 or so every single month, nearly £30, which is worth it in my opinion, because if you're going to trade a lot. But the Pro version, which has 5 indicators, after I teach you everything throughout this course, you may be able to choose 5 indicators which you really love, and maybe the Pro version is sufficient for you. And the Pro version, I think, is about £15 or £20, so it's a little bit cheaper than your Pro Plus version. So you might want to have a look at that. So that's the TradingView side of things. Then you also have different indicators that in a different platform called the MT4, which is your MetaTrader 4 or your MetaTrader 5. I've used both. I've used MetaTrader 4 and 5. 5, I'm a bit new. I'm newish to it. MetaTrader 4 I've been using for like 2 or 3 years. Really, really good. 3 years, I would say. Really nice platform. I use it mostly for trading forex, CFDs, and a little bit of maybe quick day trading cryptos, a little bit, just the major cryptos, but it's mostly for forex and CFDs. That's what MetaTrader is for, really. Forex, which is your like currencies, and then CFDs, which are your like gold indices and so on, metals and so on. So again, these are separate indicators, different indicators. I'll show you throughout this course. I'll teach you. I mean, I'll probably start the course by showing you TradingView and TradingView indicators and technical analysis via TradingView, and then I'll go on to teach you all the separate indicators that you can use, which are effective in the MetaTrader 4 platform as well, or MetaTrader 5. But I'll show you in MetaTrader 4 because MetaTrader 4 is the main one that a lot of traders use. So I'll show you there. Yeah, so at the end of the course, you should be able to do your technical analysis on all financial instruments, including indices, including CFDs, all forex, all stocks, options, and cryptos and ETFs and so on, based on everything that I'm going to teach you throughout this course on a technical basis anyhow. And you'll be able to anticipate, be able to predict when there's going to be a market correction, when potentially the market should be bullish, or when a stock might be bullish. What's the best entry for a stock? What's the best exit for a stock? So that you're not just sort of investing blindly, right? You're trading and investing based on great timing. You enter at the right time, you exit at the right time, you bag that profit, and so on. So that's how this course is going to be laid out, and enjoy it. Happy trading. Hey, welcome back. Welcome back to chapter one. So this chapter, again, the whole course is about technical analysis. This chapter, I'm going to cover three indicators, just like every other chapter. But the three main indicators, sometimes you might have a separate indicator as a part of it. So I'll include that as a part of this video as well. So for example, RSI, Relative Strength Index. There's also the divergence RSI, so that's arguably two separate indicators, but as one that's split in two, and I'll teach you everything in detail. So this one, RSI, stochastic, MACD. So let me just show you. So first of all, RSI. What is RSI? RSI is Relative Strength Index. Now the Relative Strength Index is an index, is one of your lagging indicators. Most indicators are lagging, apart from your fib level, support and resistance, and all that stuff. Most indicators are lagging. Lagging meaning that they're a little bit behind price movement. They don't move in sync with price. They're a little bit behind, but that's okay, because without any indicators, it's almost impossible to trade, if I'm being honest. I mean, you could. I mean, price action, you could. You can still trade. Yes, let's put it that way, right? For example, even without any indicator, you can tell this has done a dip at this level. There's key support right there. I mean, just by looking with your eyes, you can see there's key support. There's a chance this could explode, and even if it doesn't there, sooner or later it's going to explode, right? You're looking at support, resistance, key support, right? Just by looking at with the naked eye, you can see right here. This is such a strong sort of support resistance level right there. So if it's there, it could ride, like, and a few times it will ride big time. And yeah, so basically you can pretty much, you can see the support and resistance. You can see the price pattern, once it's done something like this and is near as at this support level, then there's a chance it could rise, right? I mean this might not be the best example. This is a penny stock, but Tesla, for example, if you just look at it with your naked eye, right there, there's a support area there, right? You can see clearly. So this might hold and it'll start jumping. There's support area there, right? So you can still trade just based on that, based on the naked eye. But with indicators, it just I just think it helps you, and then enhances your decision making in trading. So RSI, Relative Strength Index, so that is basically an overbought and oversold indicator, right? It calculates when something is overbought and when something is oversold. Now, if something is overbought, it's likely to retrace. If something's oversold, people are more likely to buy and it's going to go up. So the default setting for RSI is 70 and 30. So look, the RSI 50 is the middle line there, and if it's 70 is overbought, which is about here, actually just below my line, and 30 is about here, is oversold, right? So now, the 70 and 30 is the sort of general default. I like to set it at 80-20. Either way is okay, but like very bullish stocks, for example, like Tesla or Bitcoin even, or something like NEO, right? It tends to go beyond 70, right? Even at 70, it's not necessarily overbought. It can go to even at 75 or 80. It can even go to 90. But for me, I set it about 80. So basically meaning that if any instrument hits 80 RSI, right, at 80, which is this line here, you see that line there, right? You can see that sort of shaded area. That's my 20, that's my 80. Anything beyond the shaded area means it's overbought. I will not enter long position there on a daily anyway, because it works on every time frame, but the daily is what I'm looking for. This is more swing trading. If you want to scalp it, scalping is basically when you just in and out quick, right? In that case, you'd want to do the 5 minutes or the 15 minutes. I wouldn't really recommend 1 minute or 3 minute scalping. I mean, you could, but some people like that, but it's just not for me. I mean, I sometimes scalp off the 15 minutes, but even so, I don't do that much. I'm usually 1 hour, 4 hour daily. I'm usually a swing kind of trader. I don't like to glue myself to the screen too much, and like, because with scalping, if you want to be successful, and let me be honest with you, if you want to be a successful scalper, you kind of have to focus. You need a lot of effort and attention, right? You're not going to be successful if you just sort of take a trade and then set a stop loss, take a profit, because especially with the 5 minutes and 3 minute and 1 minute, you kind of got to watch it. And I never really do that. I'm always 30 minutes plus. So, but it depends on what you like, right? But anyway, on a daily chart, RSI, if it's 80 or more, I just wouldn't enter long on anything. Not even Bitcoin. I'll wait for it to drop or do a retracement, right? Even on Bitcoin, I'll just show you the chart for Bitcoin. So in fact, let me show you it here because I've got a watch list there anyway. Bitcoin, right? See, look, daily RSI, look, 80. See, look, this is daily RSI 80. Look, boom, right? That's not really a retracement, but that's a consolidation. 80 here, look at that, the boom. 80 here, look at that, boom. That's arguably that's 90, right? And 86, right? 86 roughly, that there, right? 86. Look what happens after 86. Pretty decent, sizable correction. Look, 80, 80. Look, see, that's 80 right there, right? Watch what happens. Boom, that correction, right? So even just the RSI alone, you could become a better trader. I use the RSI pretty extensively. I'm being honest. It's a very simple indicator, but it's very effective in my opinion. And it's, you know, I never buy something, right? I'm a bullish trader. I like to trade bulls. I don't like to short stocks. I do short stocks as well. I do them, but I do a lot less. I think it's much harder to make money shorting than to go long. So I'm a long trader. I'm a bullish trader, and I don't chase hype because shorting, if I'm being honest, your risk is unlimited and your reward is limited, whereas longing, your reward is unlimited and your risk is actually limited if you know what you're doing. So RSI basically, especially if it's got divergences, right? Now let me teach you about divergences. I might have to teach you the other two indicators in separate videos, right? I'll try and put 3 indicators or teach you 3 indicators on one video, but if it's not long enough, especially when the indicator has 2 separate sort of things like divergences, then I might have to do more videos, right? I might only cover 1 or 2 in one video. But anyway, let's keep going. So RSI, that's your RSI. RSI divergence. So this is not just a normal RSI, right? I'll show you what the normal RSI looks like. The normal RSI, if you just type in RSI, relative strength index, it looks like this one here, right down here. You see how it's 70 and 30, which is your default. To change that, you right click on the RSI line, you right click on the RSI. Sorry, you gotta make sure you click on it. Yeah, there we go. Right click on that. You go to settings. 14 is your normal lens. You could change that if you want, but I like to just have it normal, like a 14, and then you change this from 70 to 30 to 80 to 20. That's what I do anyway. So that's your RSI, right? But you see there's no divergences right now. This brings us on to the divergence RSI, which is you just put in divergence, right? It's just called the divergence indicator. So this is the RSI with divergence. Again, you want to go to settings and change it to 80 and 20 here, and inputs, go to that. Let's make sure it's 80-20 as well. No, so that's fine. Yeah, 80-20. So that's it. Yeah, 80-20 there. So make sure that's 80-20. RSI divergence is basically a divergence is whereby the pattern of the RSI is different to the pattern of the price, and when there's a divergence, there's likely to be a price correction. So for example, here I'll just show you with this Bitcoin example, which is perfect, right? And again, we're using all this on daily, right? You can do it on hourly as well. Hourly, remember, is more shorter term, right? The shorter term you go, the quicker the trade takes, right? So if you do a 15 minutes, the RSI if it's 80, and then you short it there, then the trade will probably be complete within a couple of hours or even a few minutes sometimes. Whereas if you go to the hour, the trade is more of an intraday trade, like 1 day, 2 day style. If it's a 4 hour, maybe it'll take a few days to a week. If it's a daily, then it'll take longer. So basically, that's the different time scales you want to bear in mind, right? And right now, we're talking about daily. When the daily RSI is 80 or more, you just do not buy anything. Like just don't go in. Just wait for a retracement, because usually they do. So for example, here we're on the daily RSI, and here we got bearish divergent, right? What it is that look the price. If you look at the price here, this price, right, and this price here, we got a higher high, clear higher high, right? Because look, you can see clearly the price is going in this direction. Sorry. So you can see the price is clearly going in that direction, is up, right? That's clearly a higher high. Whereas your RSI pattern is lower high. See, this is higher, right? Let me just drag this up just so you can see better. I'll just delete that. I'll get that back up later. I'll delete that as well. We can always get that back up later. So look, you see here, we got a bearish divergence. This is what you call a bearish divergence. When the price shows higher high, but the RSI shows differently. It shows lower high. So what happens there is that, especially when the RSI is at a high level, right? When sometimes they happen and they don't work. But when the RSI is super high at like 80 level, which it is, right, like here, right, and here, and especially if it's quite a big divergence, which this is, and is at an overbought levels, which it is quite likely the price will do retracements, which is what happened, right? Higher high, lower high. So when that happens, when the RSI divergence happens, it is likely, even though the price suggests it's going to go up, the RSI says it's going to go down, especially when RSI overbought. Then what you will see is a sell-off, and the RSI and the price of the instrument will go down, as it is here. So that's the RSI divergence. Sometimes you have a bullish divergence here on the bottom here, right? So I wouldn't really. This isn't really a good example because the prices are too. They're not good enough. So I want to show you a bullish divergence example here. This is a perfect bullish divergence example. Look, if you see the price here, price is forming lower low. You see that low and low, and but RSI is going higher high, right? You don't need to see these divergences yourself if you use this divergence indicator, which is brilliant. It picks them out for you automatically. So out of normal RSI and divergence indicator, I would definitely choose the divergence indicator because you don't have to pick out the divergence yourself. It picks it up for you. But anyway, let's finish this off. This, look, price is going lower low, but instead the RSI is showing higher high and bullish, and the RSI level is like 11, so the super oversold. So what happens then after that? The price rises because it is a divergence and it's super oversold. So the price rises, at least some, and in fact it actually rose quite a lot if you look at it over time there. See that? And then so this here you get a RSI divergence, bearish divergence, right? Even though price is higher high, and then you get a little correction there. See that? Again here, right? Bearish divergence, price going up, and then look, you get a little correction there, right? Because this is what we call RSI divergence. But ones that are here, I might not pay too much attention to it because, first of all, this is very small. This is not really a big bullish divergence. It's almost flat. You see, it's not really like this. See that? That is a downsloping huge divergence, whereas these are not even much. And also they're in the middle of the RSI, so I wouldn't pay attention to those. I would pay attention mostly to your... Again, this is tiny bear. Don't even bother paying attention to those. Sort of pay attention to ones where are overbought levels, and is a big one. Then pay attention to those because it's likely to retrace a little bit. So for example, this one. See that? That is super overbought, big bearish, massive bearish divergence, and look what happens. Correction. That's from 12,000 to 10,000 correction, 20% correction. That's pretty good. So yeah, again, this is a correction, and look, that correction is what, from 50, what is that, 50, I can't really see it, 58,000 all the way to 43,000. That's a massive correction, right? So that's your RSI and RSI divergence indicator. Is a simple indicator, but is a very, very important indicator to use, and I love the indicator. I use this this is a key indicator, and it's very, very effective when used correctly. So that's the RSI. I'm actually going to finish this video here. I'll try and cover 3 indicators if I can in every single video, but this one, of course, we just covered 1, which is diverted into 2. The next video I'm going to talk about MACD and Stochastic. Thank you. Welcome back. Hey, welcome back. Welcome back to another video. So this video I'm going to show you the MACD and the Stochastic. So I've got those indicators on. This is Stochastic, this is a MACD. Right, this is not the usual Stochastic. I prefer this Stochastic, and I'll show you which one. And this is the MACD. Again, Stochastic and MACD, they both have divergence indicators as well, just like the RSI that we've covered, and you trade them the same way as the RSI divergence. So just to show you, this Stochastic one is called the Stoch_MTM. So it's this one right here, right? So you want this one here, and once you click that, it looks like that. And MACD is just to install any indicators, you go to on TradingView. So right so far we've been using TradingView. We're not on the MT5 indicators yet, or MT4, sorry. We're not on the MetaTrader 4 indicators yet. We're going to go on to that later. So we'll finish off on the MT4's indicators for now. We're just going to talk about TradingView indicators. And TradingView is a platform, technical analysis, professional technical analysis platform, which I personally use. And MT4, again, I use that mostly for trading forex and CFDs, so it's a little bit different. So for this, I do my evaluation for stocks and sometimes forex and CFDs as well, the longer term picture. But I use this sort of for stocks, for options, and for cryptos as well. So you could use this for everything basically. But the MT4 has its own indicators and some really good ones for forex and CFDs, which I'll discuss later. So far as TradingView and Stochastic. So basically is similar to RSI in the sense overbought, oversold. I go to settings. Again, I like to change this to 50 and minus 50. I think default is a little bit different. I think it's 40 and minus 40. It comes as default. I like 50 and minus 50, just a little bit more like on each side. It just gives you a bit more leeway, just like the RSI, like 80-20 instead of 70-30. And what happens, this one you use it in the same way as RSI, especially if you combine the two together. In fact, let me just show you that now. Divergence. Again, RSI, remember I like to use the divergence one. It's just a little bit better. Okay, I'm just going to delete one of mine. Don't worry. I'll delete this one. That's fine. Because this is another thing with TradingView. You're allowed, if it's a free account, you're allowed 3 indicators. If it's a pro account, you're allowed 5. If it's a Pro Plus, you're allowed 10. I personally use the Pro Plus, which cost me about £25 or something every single month, a subscription fee, but I think it's worth it for me because I trade like a lot, and I trade like on a daily, or if not definitely weekly basis, and I personally find I need about at least 7 or 8 indicators to trade effectively. So I had to take one off. Now I can put one on. Divergence. There's your divergence indicator here. So if you combine the two together, you see, let's put this up. See this? If you combine the two together, this is overbought, this is overbought, and you know, even if you combine the 3, this is all of them suggest it's overbought. Boom, go for it. So basically, if you see if it goes to here, if the stochastic goes up there and it's showing red, it shows it's overbought. So if that shows overbought and RSI shows overbought with bearish divergence, don't go long. Right? Wait for it. Wait for this period to play out. You know, and then after this retracement, now this is down here. This is like 50 on RSI. That's where you go in, right here, somewhere around this region, and ride the next wave. That's what you want to do. Again here, overbought, see, especially with the stochastic, right? What I find is that the bigger the bulge, this bulge here, see that the bigger the upper bulge, the bigger the correction. I have found anyway. So here, that's not huge, you see this, but there's quite a period, and that's the correction. This is bigger than that bulge because it went higher, and look at that correction, that's decent. And then look, this is huge, and look at that correction, right? So that's how you use that. Same on the other side. If it's oversold, especially on a bullish stock, right here, this is oversold. You can see that right here. This is oversold. This is showing green bulge on the bottom, which means it's oversold. And RSI, we're talking 30 something, so that's oversold by here. This is a good entry right here. This is a good accumulation zone right there, and then you just ride it all the way out. Look, you could have gone here and held it all the way until if you want, you can hold all till here, or you know, just watch it, and then just, you know, anywhere here you can get out. Like anywhere between this range and this range you could have got out. I probably personally would have got out sort of this range between here and here. That's probably where I would have got out. And then you wait for the retracement, you go in again. So basically, yeah, again, that's your overbought, oversold. And now we're on to you. And again, stochastic, you got your stochastic divergence as well. So for that, you just type in stochastic divergence right there. If you click that, what happens? Let me just maybe take this off and I'll show you. It's the same idea, stochastic divergence. Same idea as the RSI, really. So you see, you got this is a bullish divergence, and that's bearish divergence, higher highs, bearish divergence. So you just you know, it's just basically the same idea as the RSI. Like here, this is bearish, right? I personally, right, my favorite is in terms of divergence is actually the RSI divergence. I use that a lot, and I use RSI a lot. I find that really good, and I find the stochastic is really good as a combination used together with RSI, especially if you combine the overbought and oversold at the similar areas. Together, it just gives you a bit more confirmation. You you can use the divergence on the stochastic if you like. And then now we are on to the MACD indicator. Now MACD indicator, which is right here, again, basically the MACD indicator, when those lines, right, are below, see how you got the middle bit, this, you got the red and the green, right? When the lines are below it, it's bearish. When the lines are above it, it's actually considered bullish. So this is a correction, but even with the correction, it's still in the middle of the mid-range, right? It didn't really, let's close this so we can see this bigger, right? So here, this is your MACD, right? Like for example, here, this is where you call, like this correction here, this is a proper bearish correction right there, here, right? Because if you look at the MACD, it's actually below. See how this is the middle zone, right? It's below it. That's a proper if you like, a big correction on the MACD. And when the MACD on something as bullish as Tesla goes like that below it, and then it starts to come up and cross, see how there's a blue line? Basically, when the blue line crosses the orange line above is bullish. When the blue line crosses the orange below is bearish, right? When it's like below this middle region, like this, and it starts to cross above, that's where you would go in, and you could ride quite a lot on something like Tesla, especially, well, a stock like Tesla anyway, or NIO, for example. You know, that's how you would use the MACD for this. So if we now come back to sort of modern day here, you know, again, you would use it sort of in combination probably with the stochastic or RSI. You can use this in combination with the other one. It's just more, especially with MACD, I find it more effective. You use MACD together with combine it with either the stochastic or combine it with the RSI. It's just a little bit more efficient. So again, here, see the blue line crosses above on the orange line. When that happens, the price is going to go up because it's bullish momentum, and now it's coming down and crosses here. That is where you would get out. So let's say you enter a trade here on this bit here. This is where you enter on the RSI, on the MACD, and this is where you want your RSI as well. So let's just get the RSI out here just to combine it together. You want to double check here what your RSI level is. So it's okay. It's not too overbought, because right here RSI is about 60. 60 is okay for a stock like Tesla, because Tesla can literally take the RSI to 90. You know, just like Bitcoin. So, but if it was 80, I wouldn't bother. And definitely if it's 85 or more, I wouldn't bother entering long until after a retracement. So you would enter here, combined with the RSI, you ride it all the way until the MACD starts to curve down the way and touches the orange. So your entry would have been made here at what? This is Bitcoin. Yeah, sorry. Yeah. Anyway, Bitcoin, right? So I thought we were on Tesla. Bitcoin. But Bitcoin arguably is actually even more bullish than Tesla right now, so this is a really good example anyway. So Bitcoin, we would we'll be on Bitcoin. So you would have entered here at 19500-ish, and you would have ridden all the way and crossed here at 33k. So that's a massive ride, you know, on a daily chart, just based on MACD alone. Massive ride. So that's how you would use the MACD, especially on a bullish instruments such as Bitcoin or Tesla or NIO, these kind of things. You know, they can even take RSI to 90. But again, if RSI is 85 or more, I just wouldn't really bother going in. It's just too risky. It's bound to do a retracement sooner or later. Like here, for example, look, RSI was 80, and that's when it did the retracement. Sure, over there it went to 86, but you know, if it's 85, I just don't go in. I just wait for it. Even if it can go up a little bit more, it only goes up that little bit more before a correction comes. Same here, look, 80, as soon as it touched 80, 81, boom, look at that correction. So you know that, combining the RSI with the MACD together, really, really powerful, really, really good strategy. Again, your MACD also comes with a divergence, MACD divergence. So again, it's quite similar. It tells you when there's a divergence. So basically, it's just like the RSI divergence. You would then take that into account, but you only take it into account if if it's overbought, which it is here, and it's telling you divergent there going down, so that's where you can just get out there, right? So yeah, so that's your MACD. But I would use the MACD in combination with Stochastic or the RSI. It just gives you more, because it kind of, the RSI and the Stochastic gives you overbought and oversold signals. And if you use the MACD as a confirmation of when to get out, when to get in, it can enhance your overall strategy a little bit more. So that's that. Thank you guys, and come back to the next video. Hey, welcome back. Welcome back to the next section, next chapter. So this one, I am going to cover another few indicators, and I'm going to cover trend lines, support and resistance, and volume with you. So volume is actually doesn't count as one indicator you can have. So the volume here, so that one is one of those that's a free indicator, like it doesn't count. So even if you're on a free version, you can have 3 indicators plus volume, or if you're on the pro version, you can have 5 indicators plus volume. Volume doesn't count as an indicator. So I'm going to do it on the Tesla stock here. And this is so volume. To get volume, again, you go to the indicator icon here, and then you just type in volume, and then just click that. Once you click that, it will show, and these are your volumes on the bottom. You see that? These are your volume bars. So for example here, there's a lot of volume there, and these little ones are lower. And if you want to know precisely how much volume, you can just sort of hover over there, and you can see there's 222 million on that day. That daily trading volume was 222 million, which is a lot, which has got a lot of volume there. So when volume's high, you might get a depending on the stock, whether it's bullish or bearish, and depending on what sort of activities are happening, you can see is it more bullish or is it more bearish. So volume, you kind of need that, just have that on there all the time basically. And then we have support and resistance, right? These are dynamic support and resistance. So that one in particular is the, let me just see. Right, so this one's dynamic support and resistance. So I'm going to show you a few. So you can have the dynamic support and resistance. You can have supply demand light, which is those kind of lines there, right? These are basically, and this green one here, for example, these are supply and demand. These are basically areas of major supply and major demand. So when the price, if the price was to drop to here on a daily, you have so much demand, it will go up. But with Tesla, it shouldn't drop that far. And you have these kind of, and then you have this one, which is the supply level, this red here, which is might hold price down. And then you have these little lines here, which you can see, these ones here. These are all your sort of support resistant light. So that's this one here. No, sorry, this one, support resistance, this one here. So supply and demand light is those ones here, this one. These sort of biggish blue, red, and green. So if you actually have it on hourly, you'll see much more of that. So supply and demand there, supply demand there. Well, these are supplies, and then you green ones are your demands. If we go back to the daily, you then have your support and resistance, which are these kind of lines. That's a resistance, that's a support. Resistance, support, right? So support is something which, if price drops down to, should support the price. If price is on a rise, then the major price point is above it. That's a resistance, right? And once price takes over that resistance, then the resistance becomes support. And the best one is actually this supply support resistance dynamic, right? So these are your major support and resistance, that like here, see these dotted blue ones, these are your major support and resistances. This is quite a good one. This is the sort of these are your sort of major support and resistance points. These are what you call that. This is the indicator dynamic support and resistance. To be honest, even without them, right, let's just so we can turn this one off, turn this one off, can even turn this one off, right? Even without them, right, you can sort of tell, look, just by using your naked eye, if you once you are a good trader, trade a lot, you can see there's a resistance there, support there on the daily, major support right there, support here, You can see there's support resistance right there. Look, price is resisting here and price is support there, like this. All these kind of levels, these are your key zones. Again, you got support resistance around about this level here. You know, just by looking at it with your eyes, you can see once you've traded enough times. But if you want to make your job easy, just have the support resistance dynamic, have it on. Right, again, you go here, you type in support resistance dynamic. Right, you type that and then you choose that one there, dynamic, and then you put it on, and then that's it there. Right, so everything's done for you. So look, this is support resistance, this is support resistance, this is support there supporting that price, and then there's a support resistance here supporting this kind of area. So yeah, so that's that. You know, that helps you to guide you, right? That guides you a little bit in the sense that, let's say this price is dropping here. Where is it going to drop to? It might drop to this support here. Once it drops to support, if it drops more, it'll drop more. But if not, this is likely to hold, especially a bullish stock. Then it might start going up from there. But again, this is just, you know, this is just based on support and resistance. But if you watch all the videos all the tutorials that I'm going to teach you throughout this course, once you've completed them all, then you can decide what indicators and what technical analysis that you are going to put together to trade in your own strategy, which is based on your own style, really. So have that. I think this is really, really useful because you need to know where your support and resistances are. You know, it makes sense. And then you have and then this trend line, which I'll show you. There's many trend lines, but I prefer this one because it doesn't change the outlook of the whole chart, because there's a few other ones, if you put it on, then the whole chart sort of looks like this. It just gets squeezed and you have to sort of drag it up and everything all the time, whereas this one, it doesn't get squeezed. So this is called the Trendline Tories, right? So this one basically, so here, there we go. So this one, if you put that on, so it basically has those dashed lines, and this is basically your trend line, because you know how like in trading you got trend lines, right? You can do this yourself. You can draw trend lines yourself, right? A trend line is something that looks like this, basically, right? That's a trend line. Basically, a trend line is something that the price sort of is like is a natural support, which the price respects on the way down, retracing. So each time, watch, see, for example, here, if you actually drag this one more like this, look, that's a support. Trend line goes up, comes down to it. Well, in fact, this isn't the best trend line here. You know, you don't even need this trend line, right? Because the trend line is right here, right? This is the trend line. So you just, if you watch here, right, arguably you can drag this down lower to here, this level, but anyway, if you watch here, price goes up, comes back, respects it, doesn't break below, and goes back up, comes down, touches it, goes back up, touches it, goes back up. Now it's coming down. If you extend this to here, so it's really pretty much at that trend line. So again, what might happen is that it will come down to respect this trend line, and it'll probably then keep going back up, because that's a trend line, right? So again, here you got a trend line here. So this is a downtrend line, right? So I'll show you the downtrend line. Downtrend line is where the resistance, right, on the top, the price respects it. So here, price goes up, respects it, goes back down, goes up, respects it, goes back down, goes up, respects it, goes down, up, down, up, again, respects it. So that respects it until it's broken, then that trend line stays. But if that trend line is broken, then you need a new trend line, and which then comes to this bit here, which is the next trend line. And of course, now you got an uptrending stock, which is here, and that's the trend line. So unless if this is broken down, this trend line is respected and ongoing, right? So that's how you would use a trend line. Whether it's if it's an upward trend line, it's below the price. If it's a downward trend line, it's above the price. And this is what I call a triangle, right? When you have a trend line like this here, and then a trend line like this, that's a bullish triangle breakout, right? If you go and Google bullish triangle breakout, right, that's exactly the pattern it is. So basically the price comes from below, goes up, and then it consolidates, and it consolidates more and more until when it's got in such a tight range, it's like a triangle. It's called a bullish flag or bullish triangle breakout, this pattern, right? And then once it's there, what happens is that it will break out one way or the other. Sometimes it can fake breakout, right? Don't just take this as 100% is going to break up, right? Because what can happen is it breaks up and boom, breaks down and then goes back up. That can happen. But usually when a bullish stock is in this kind of triangle pattern, consolidation pattern, it usually has a chance of breaking out. So that's something to look out for as well. So that's your trend line. There's also other trend lines which you can try. Just type in auto trend line, and then quite a few trend lines will come up. Then you can start trying them, try them yourself. But a lot of them tend to alter the sort of chart, and then you have to then drag around and stuff, and it's a waste of time. I find this one doesn't alter it, so I quite like this one. Also, you can see it with your own eyes anyway once you're quite experienced with it. So there's that. There's the support resistance. There's the support resistance there. The little smaller ones which are there. There's like basically more. There's more of them, but these are your key support and resistances, and these are sort of more holding points, more support and resistance, if you like. And then you got your supply and demand light, which is your major support and resistance here, major supply and demand areas for that. And then you got your volume, which is the volume there. So these, again, you can consider them, so far we've covered RSI, we've covered MACD, we've covered Stochastic, we've covered Divergence, and we've covered support and resistance and trend lines. So and support and support and supply and demand, right? So we've covered like quite a few good indicators there already. So out of the ones you like, you may want to put them together and then trade it in your own way. At the end of the whole series, at the end of this whole course, I will share with you what is my favorite setup and what setup I trade off based on my 10 indicators. I'll show you that as well at the end, just to finish off. But again, I want to show you most of the indicators out there, and you can decide what you want to use yourself, right? So again, these kind of indicators, you can use it for scalping as well, because basically if you go to a lower time frame, then your support and resistance are still applied, but it's just on the lower time frame. And you have your trend lines as well, and you also have your major supply and demand areas. Again, this is just a lower time frame, so your trade will complete a bit faster. Whereas if you use higher time frame, then your trades are more for swings. It just depends on your trading style. Personally, I'm a swing trader. I like swings. I don't like to spend too much time every few minutes watching a trade, and it just takes a lot of effort and energy, and you don't really need to, because during a bull market, if you trade bullish stocks, most of the profit, most of the move is made on the swing, to be honest, in the long run, in the swing term. So yeah, I hope you enjoy that, and come back to the next course where we will cover more indicators and more trading strategies and more patterns. I'll include trading patterns as well, like your flag breakout or bearish flag, double top, double bottom, head and shoulders, higher highs, higher lows, all that stuff. I'll include all that as well later on in the course. Thank you and happy trading. Hey, welcome back. Welcome back. I hope you are enjoying the course so far, all technical analysis. Pretty much, I'm going to cover all the major indicators with you throughout this course. So we've covered quite a few already now, but there's a lot more still to come. So in this chapter, I'm going to cover with you your EMAs or MAs, which are your moving average. There's basically two types. There's simple moving average and there's exponential moving average. Basically, well. Yeah, anyway, I'll explain that in a sec. So basically there's that. There's also golden cross close, when there's two. It's basically when two certain number EMAs cross is considered a golden cross, and is going to go the other way. I'll show you that, and also show you the super trend. So EMA first. These two you don't really need. I suppose we'll just remove them, because you should know them by now. The stochastic and RSI. So I'll just remove them so you can see the screen a little bigger. So first of all, EMA, right? There's a few EMAs you can have. So if you go to indicator again, if you type in EMA, you can have EMA. These are the main ones, basically. You got your 20, 50, 100, 200. These are sort of your major, if you like, EMAs. Or you can have whatever other EMA you like, EMA crossing strategy or something like that if you want. Or moving average. I think there's yeah, so just basically whatever you see fit. So moving average, if you just type in moving average, there's a lot there. You can have a single one, you can have triple, you can have exponential times 4, you can have whatever, you know. But in this case, I personally, I prefer this one, which is one indicator comprises 4 of your main EMAs, which are your 20, your 50, your 100, and your 200. So what they are, basic EMAs, exponential moving average, is the average closing price of the most recent 20 days, or the most recent 50 days, or the most recent 100 days, or the most recent 200 days. So your 200 days, the difference between EMA and SMA is that EMA is more weighted towards the recent past, whereas simple, it's not as it's not as close to the recent. So that's the only difference. So EMA is more weighted towards the current times. So the average, basically average closing price over the past few however many days. So if I draw your attention to this line here, which you can see is the red one here, right? Wait, let me just just so that we're not confused about it, I'll close a couple of this so you can see, right? Right. So this is the red line, which is your EMA 20. You can also have if you want, you can have an EMA 9 there. So you just type in EMA. If you just want a single one, you just type in EMA, and then this is moving average at exponential. That's it there. You click that. Or if you want a simple moving average, just type in moving average here, and then it will have moving average. So that's your simple. The one that doesn't say exponential is your simple. Again, simple is sort of your average over the last 50 day, 100 day, whatever you choose, but it's not more weighted to the current times. So now we have an EMA here. The default EMA is set on 9, which is good, which is kind of what we want. So I wanted to show you that the EMA 9 is quite a common one, and that's sort of your natural stop loss, right? That's your dynamic stop loss, if you like. So basically, if you were to trade or intraday trade or something like that, what you would use the EMA 9 as a stop loss, like a dynamic stop loss. So for example, here at this period, you wait, and when this takes off above the 9, you take a long trade, and you wait until the price breaks below the 9 EMA, and then you would get out, and then you would intraday, you sort of shorter swing that kind of profit there. It's more effective if you use it together along with an RSI Divergent or a MACD or a Stochastic or Williams percentage or something like that, which I'll show you the Williams percentage in a later section, but you already should know what the RSI is, you already should know what the Stochastic is, so it's better if you combine this together with those, but I've already showed you those, so you should know them, and this is more on EMAs and your trend this session. So that's that. You could use the 9 as a quick stop loss. The 20 is a stop loss, but a bigger stop loss. So you see how the price tend to respect the EMAs a lot. So if you look at it, this is the daily chart for Tesla. When it rises, look, the price comes down and literally hits the 9 EMA and then goes back up. But if it breaches, the 20 is likely to hold next, and 20 he keeps holding the price up until it breaks below the 20. It becomes more bearish, and then you let it go. But then you see how here this is the EMA 50 now. This orange one here. So the EMA 50 again held price up. So look, price tested it and then tried to go back up. I couldn't, so it broke below to the EMA 100, and now it's at the EMA 200. Now EMA 200, if you actually look back into in history, is a highly respected EMA. In so many ways. If it breaks below it, the price is very bearish. But Tesla can be a really can be a volatile stock, if I'm being honest, right? If you look at something like Apple, right, the EMAs are a little bit more better. See, look, the EMA 9 is holding the price. EMA, if that doesn't hold, 20 holds. If it breaks below, then it's a bearish sign. You would get out anyway. And EMA 200 tend to hold price really well. If it doesn't, then it's going into a bearish to territory. So you see this, see how the 9 or see how accurate that is. That literally just hits that, and then it goes up again. This hits that and goes up, and see how well the EMA 20 holds. See how many times the price actually touches it, respects it, and then goes back up, right? And now this is a total change, right? But this, everything was like that during that time. This was the COVID 2020 dump, right? Every stock did that. That's understandable. Again, you see how well respected they are, these EMAs, right? But they don't usually break EMA 200, right? If they do, then it's a bearish signal, very bearish signal. So you can use these as your sort of dynamic support and resistance to give you a guide as to when to enter the market. So what you could do is during a crash or during a market correction such as this, right? Usually if there's a market correction, I start adding starter positions on the EMA 50, which is this orange line here. I add a starter there on bullish stocks, of course, and only starter. And if it drops lower, I'll add again here. If it drops to here, I'll add quite sizable here, right? And then you ride a wave back up, because a bullish stock, based on history, the market always recovers, and it recovers quite fast, even during a market crash. I mean, look at the COVID crash. Even during a crash like this, within just like, so the crash started in end of February, and then by end of March, so within a month, it was already into bullishness. I'm not saying that's always recovers that fast, but market tends to recover, and when it does recover quite quick. And so, I would say the 50 is quite a good point during a correction to add. So here, look, right there, that's the correction. If you added at 50, you would have caught all of that move, right? If you didn't add at 50, sometimes it doesn't drop to the next one, you miss the whole move. Right, but you can combine that along with your RSI, along with your MACD, or along with your stochastic, just combine the whole thing together, and it's just even more powerful, right? Again, if you started adding position here at this correction at 50, sure, you would have had to hold some red there, but look down here, you would have added your second lot of position, and then after that, within a week, you were in profit anyway. And within a month, you would be more profit, on a stock like Apple anyway. So that's your EMAs, which I think are powerful. I usually have these, though the key ones are really EMA 9, 20, or 21. For scalping, you can use a 2 and an 8 as a scalping crossover thing. Basically a scalping is, for example, I'll just show you on the 9 and 20. Basically, you see when this is your 9, this is your 20. When the 9 here crosses down below the 20, that is when it's a bearish sign, you let it go. And especially if it crosses below the 50, that's a bearish sign, let it go. So for example, if you took a long trade, let's say here, entering long, you hold, and this one, then you probably would get out there, and that's still a profit, because that 9 is crossing here. But it's better if you use a 2 and an 8 for scalp. That's more of a scalping strategy, a 2 EMA and an 8 EMA, or a 3 and a 9, or something like that for scalping. You go long when it crosses up, especially on a bullish stock, and then you let it go when it touches again the EMAs. So that's another way to trade with the EMAs if you want. That's more of a scalping intraday trade. I prefer swing trading, so I use these bigger time frames, and at the 50 I start adding, at the 100 I add more, if it goes to 200 I add quite a lot on a bullish stock, right? Not just on any stock. And you want to judge, and you want to time it with you want to see the volume, and you want to see the RSI, and you want to see the stochastic. You combine your whole index, everything you've learned so far together, and so that's your EMAs. And then you got your so let's turn off the EMAs now, and let's go to the golden cross, right? This is the golden cross, which is basically a EMA cross, right? These are automatic EMAs. Basically, when the EMA crosses here, see how there's a plus sign? That says that this is bullishness, because the green one is crossing on the red one above. So basically, your lesser EMA. So basically, the green one, but that's a lesser EMA. By the looks of it, it's probably a 9 or something, 8 or something, and then that's probably a 20. So basically what's happening here, right, is basically when the smaller one crosses the bigger one, it is bullishness. So right here is where you would buy the stock, and you ride it all the way until it sort of touches. Maybe here, this is where you get out, and you could have caught all of that move, and you ignore all the noise. You ignore all the noise in the middle. You have to be, I think the bigger money is in trading is made in the swing anyway, swing trading, right? I don't mean holding for years, because there's no point in holding through this, right? Like I personally prefer swing trading because that's where is the best overall in my opinion, because you don't have to spend a lot of time, a lot of screen time focused, right? I do scalps as well. I used to scalp a lot, but it's just tiring. You have to focus your attention. You need to, I mean, if you want to scalp 15 minutes or 5 minutes, literally, you do need to focus. You don't have to, but if you don't, your profit is less. If in scalping you want to focus quite a lot and exert a lot of energy to be profitable. Whereas in swing trading, you just enter at the right time based on RSI. If the RSI is quite low level, and then you got a crossover on EMAs, you just enter and then wait. You can look. This whole period is arguably what. Let's see. So this is April, end of April until September. So for 5 months, you could have held the stock from $68 to $125, right? And then you don't have to. Like the whole noise. You ignore every noise in the middle, and you catch all of that just based on this indicator plus the RSI alone, right? And you don't have to do any work. You literally buy and sell, right? But I don't hold for too long because I don't see the point of being up by like 100% and then just to be down by 30%, like, but just to be down by 25% afterwards. I don't see why we shouldn't protect this profit, and then after the down, when it correction's over and then goes up, that's when you buy back and then ride the next wave. That's really, like, for me, that's my favorite type of strategy, is to swing trade for a few days or a few weeks or a couple months max, and well, not even a couple months. I might even sell here, for example, right? For example, I might buy here, and I probably would have sold here and bought back here and then ride the next wave, right? Because when the RSI, if you put the RSI back, you probably get a better idea what I'm saying here. If you put the RSI back, you see here, you buy here because RSI low, and then when RSI is here, which is your 80 something, you get out here at this level RSI. So you would have already made from $68 to about $83, and then you get out, and then after this RSI retrace, get to a lower level, even here, you then go in here again from there, and then you ride that wave, right? That's really my favorite kind of swing trading. Doesn't take a lot of time, doesn't take a lot of focus. You enter at the right time without chasing hype, and you get out at the right time when it's overbought, when RSI is like approaching 80ish or 75 if you want to be safer, and then once RSI retraces to the reasonable level, you enter again for the next ride. That, I think, is the best way to trade. You catch a chunk of the move, big chunk of the move, and you don't have to exert a lot of energy and time looking after a trade. So that's that. So we've talked about your golden cross, and we've talked about EMAs and SMAs. So that's that, and come back to the next video. Happy trading. Hey, welcome back. So welcome back to another section of the course. So this one we are going to talk about the Supertrend indicator and probably the Williams percentage as well if we have time, which we should. So Supertrend, again, you go to where the indicators are, type in Supertrend and pick that one, or you can pick this one which has the buy or sell signals. So here. So basically you can see the buy and sell signals, and you can see this trend holding it up. So basically what this is saying, you can, if this says buy, you buy here, you can hold for as long as this doesn't come up with a sell signal, and then when the sell comes up, you sell, right? And again, same with this one here, you buy here and hold it all the way until it says sell and sell there. And that would have been a couple of really nice rides there, But on top of just technical analysis, right, I want to just show you how I would use this myself. I would see this buy. First of all, I want to see what the RSI is level on this. So RSI is like 40 something, which is good for Apple. I mean, that's very low, especially after a bullish divergence here. I would definitely have gone in here. And what I would do is I would probably sell partial right there, because the RSI there is nearly 80 and there's a bearish divergence. So I would have sold partial there instead of waiting for this, right? Because I think it's always good to protect profits and to sell partial along the way, because no matter what instrument, no matter how bullish, whether it's Bitcoin, Apple, Tesla, NEO, no matter how bullish that instrument is, it cannot continue to go up in a straight diagonal line forever. It just can't. It has to do these corrections or retracements. Look at this retracement correction there. Even if it's a bullish stock, look, there's a retracement there, retracement there, retracement there. There is always some sort of correction. Nothing goes up straight line green every day. It's not possible, which is why the RSI is such a good indicator. So right there, RSI is like coming up to 80. That's where I would have sold, at least sold partial. I might have sold all and bought back here, or I might sell it half and I'll ride the rest half, right? And when this sell comes out, I would sell the whole thing. So this is quite a good indicator even by itself. You just follow the trend, right? As long as you enter at the right time without chasing RSI, because RSI 40 something for Apple, especially after a bullish diversion, is super good. You know, just get in. You know, even a big position is quite feel safe about it, and then you'll ride up with it, but that's how I would do it. And I just want to show you, so this is how you do it, and then this is telling you to sell. Now selling, right, I just want to explain a little bit about shorting. Shorting a stock is where you borrow stock and you then buy back the stock to cover, and you make money basically when the stock drops in price, right? When you long a stock, you make money if the stock price rises. When you short a stock is when you make money if the stock price drops, right? But I wouldn't recommend shorting a stock such as Tesla or NEO or Apple or Bitcoin during a bull run, right? Especially during a market bull run, because or SGen or Nvidia or advanced micro devices. I wouldn't recommend shorting extreme or really nice bullish stocks during a bull market, because it's very risky. And with shorting, I mean, you got to know what you're doing. It's quite good during a market correction, especially if the particular instrument is overbought, like 80, and then the market's about to correct. It's okay to short then, but when you short, you should have risk in place, because with shorting, your risk is a lot higher. If you don't put risk management in place, especially if you're shorting like a small market cap stock, you could lose a lot of money very quickly. Shorting is much more risky. You get short squeezed. It's much more challenging, much more difficult. I personally believe it is much easier and much more profitable if you go long during a bull market on the right bullish stocks at the right time. It's just so much easier than shorting it. But I mean, I do short stocks. Don't get me wrong. Shorting is quite good sometimes, but you just need to be careful when you short stocks, especially bullish stocks. That's all I'm trying to say. So again, you just basically buy and sell, and then follow that trend. This is quite a good indicator even by itself, completely free. You might have this one. I might have shorted. Reason being, right here, this one I would have probably shorted. Reason being, RSI is 85, and I'm pretty sure there was a market correction there on the US indices, probably the Nasdaq and the probably even your Dow Jones and your S&P 500 for sure. So I might have shorted that. That I would have been quite comfortable to short that, but I wouldn't short, like for example right here, I wouldn't short it because RSI is like 35 and the market correction is probably already done. I wouldn't short like at this level. I would wait for it and then buy long. I would actually enter long right now, like partial, and then go long with it. So just wanted to explain that. Again, combine this together with RSI. RSI, if it's a good level low, this says buy, go for it. And especially if you've learned about your EMAs now, see what your key levels are on the EMA, then go for it. I just wanted to show you the Williams percentage, which is very similar to it's quite similar to your stochastic and RSI. It basically shows your overbought and oversold zones. So again, here, look, for example, this Williams percentage right here is oversold. It wants you to go long, right? So look, if you had gone long, look, you would have caught this move, right? Now, Williams percentage has an advantage over the RSI in the sense that, see, the RSI is actually at 50, but the Williams percentage is oversold right there, right at minus 90, right? Williams percentage works a little bit differently. It is overbought if it's here at this line here, right, which is your minus 20 bit, and it is oversold when it's at this line here, which is your minus 80 bit, right? So even though the RSI is only at like 48, your Williams already at minus 92 or 93, which is super oversold. So if you combine that together with your RSI and together with this is quite safe to say you can go for a long position right here and go long more, right? And look, when your Williams percentage is overbought on the top, sooner or later it's going to do a dip like this, right? But if it just wobbles around, if it doesn't cross below this overbought line here, it's okay. You can stay in the trade. But if it does go more low, that you get out. And look at this right here. RSI is at 80. This is super overbought. Everything's suggesting overbought. Boom, and then when that happens, you tend to have a pretty decent pullback like that. So there's no reason to hold the stock through like a 25-30% drop. There's just no need. You bag your profits and let it go, and then buy back. When look at Williams percentage, look afterwards. Look here. When it starts to go up again from there, that's where you buy back. Or you buy here when this thing says buy, right? And RSI is at a good level. And then you buy it and you would have rolled it to here, wherever you wish. That's a profit, right? Small profit is a small profit, big profit there is a big profit. So Williams percentage works in the sense that even though the RSI is like in the middle, it can say it is oversold here and you can follow it long. Same with, again here, same with all of this move. See, look, RSI is wobbling around 40 to 60 something level, right? All of that is sort of just consolidation on the RSI, but the Williams is showing you exactly what's happening. Look, it picks out all these sort of consolidation moves as well. Overbought right there, sell, boom, oversold, buy, long, there, goes long, overbought again here, and then boom, sell. Here, oversold again here, right, and then there. But in a way, so it picks out all the sort of consolidation ups and downs as well, instead of the RSI which just stays flat. However, again right here, see, look, our Williams percentage is oversold. It's better to go long now instead of like, see, this is still, well, if you shorted it here, I wouldn't have even shorted it there because the RSI is too low, like 50. Williams in the middle. I just wouldn't short that, especially during a bull market on a stock like Apple. So this is just purely a healthy market pullback correction because the US 500, the US indices are super overbought. It was, I think RSI was 75, and this is, everything corrects when the US index is correct, right? Because that's how your technical analysis work. Right? I'll just show you the US 500. So if you actually go to the CFDs, and I'll show you the US 500. See, everything corrects when your RSI is like 70 there. Williams percentage is overbought there. So the market is just a healthy correction, healthy pullback, right? I've even said this. I caught this correction back here somewhere, and I caught this correction, and I caught this correction a week prior to them happening, because of all these things I've been looking at, and the VIX. The VIX is your volatility index for your S&P 500, right? The VIX is all the way here at the bottom, right? When the VIX goes up, your US index drops. Look, the VIX at this stage has nowhere to go but up, so the indices are going to drop. So based on all these technical analysis skills that you will learn in this course, or you have already learned some already, you are going to be able to sense when the market's going to correct, when the market's going to bull run. You're not going to be 100% accurate. Nobody can be with these things, but you're going to have a good idea. So before a potential market correction, so for example, you use your Williams percentage. Look there, it's overbought. US 500 is overbought, right? There's a bearish divergent. Your RSI is 71. Especially that. Look, whenever RSI hits 70 since about September, which is like the last 5-6 months, it tends to retrace, and especially this is telling you to sell, and then you got your Williams percentage is overbought. There's some, and then your VIX, that's your volatility index for the S&P 500. When the VIX goes up, your US index comes down, right? Because they go opposite directions. So when your VIX is here at key support, because look, right there, this level right here is key support, right? And VIX is here at key support. It's very likely the VIX will go up, which means your US index was going to drop. So you can anticipate these kind of moves. So that's your Williams percentage side of things, which is a little bit different to RSI, but similar in some respects. So if you combine that with RSI, along with maybe your stochastics, which I've showed you back in one of the earlier chapters, along with the Supertrend and and your EMAs and your trend lines and your support and resistances. You can see how all this is starting to fit together now. That's really going to help you on trading the right stocks at the right time without chasing, and during the right bull market trading the right stocks. You are going to profit by following these strategies, right? Because what happens if you don't know these things, right, is that people tend to buy at the peaks, right? Because that's what happens. If you're only following emotions without following strategies or technical analysis or fundamentals, if you don't follow a plan, all you're doing is following emotions, what happens is that most people don't, like, if you don't know this stuff, you're going to buy at the, like, oh shit, I'm missing out. Look, FOMO kicks in, right? These are the levels where FOMO kicks in, fear of missing out, these kind of high peaks, right? And that's what happens with a lot of people. The traders like, oh shit, this is really good, I don't want to miss out. And then you start investing when the RSI is like 80, 85, 90. And then what happens? The correction's going to happen. Of course you're going to lose it. And then you sell after correction, and then if you had held, you're going to make it back anyway. And then fear of missing out comes again here at the super overbought level, and then again market corrects after that, and then you're going to lose out again. But whereas if you have this knowledge, even just the RSI alone, it's already going to help you improve your game and enhance your game. And I hope you can see that. Go out there and use it. If you're trading the right bullish stocks during the right market conditions in a bull market, when you're not chasing when it's super overbought, you're going to make money in this game in the long run. And that's how you're going to succeed at trading. On top of that, you need your fundamental analysis and sentiment analysis. I also have other courses. In fact, I have a few other courses in this on Udemy which teaches you all that. There's a stock trading course which is called, I think, Profit Consistently Trading Stocks and Options, 80% plus win rate. That one teaches you technical analysis, fundamental analysis, and sentiment analysis. So you can check out your sentiment and fundamental analysis through that course, and with that course together with this course, which teaches you everything about technical analysis. The other course teaches you some as well, but not in this detail, and you are going to be a successful trader. I'm confident in that. So thank you, and come back to the next course where I'll share with you more indicators and more technical analysis. Happy trading. Hey, welcome back. So again, I really hope you're enjoying the course so far, and I really hope you're finding it valuable. I believe there's quite a lot of value that you can gain here. If you start trading in this way, you are likely going to be a profitable trader, as I have been for a couple of years. So anyway, this chapter, I'm going to show you a few bands, right? A few bands or channels. So there's quite a lot out there, right? There's Bollinger, your sort of common or your typical ones are your Bollinger Bands and your Keltner channels. Right? I'll show you those first, and then I'm going to show you a couple of other ones which are less familiar but better in my opinion. I don't actually particularly like the Bollinger Bands or Keltner channel that much. I prefer these other bands which are a bit more accurate in my opinion. And actually after this course, I'm actually going to show you another course, in another section on the same course, another section where I cover more bands with you which are highly efficient. So Bollinger Bands, here we go. So Bollinger Bands basically is a traditional band whereby it covers overbought and oversold levels, right? So basically when the price is at the top band, is overbought, is likely to retrace, and the band is at the bottom level, it's quite oversold, is likely to go up. So again here, this shoot through the top band is likely to come down. This has touched the bottom band, is likely to go up. So that's basically your Bollinger Band, right? But it's not very effective when you have something like this, like a market crash. But again, with the fundamentals, if there's a COVID and something like this happens, you might not enter here anyway. You might wait for more drop. It just depends. Or even if you did enter here, I would get out if you were in a loss again. So but you see how the Bollinger Band just sort of follows the whole price no matter how far it goes, right? So you might be buying here and then buying here and buying here, right? So So for a few reasons, I don't really like it as much, but it's okay. It's pretty good. It gives you an idea and guide as to see. Look, when the Bollinger Band, the price shoots right through. It's got nowhere to go but to come back a bit. So that's quite good in that perspective, right? So that's your Bollinger Bands. Especially sometimes there's a Bollinger Band squeeze strategy. So this is the US 500 that we're just using it on, right? You could use this for any instrument really. You know, Bollinger Band squeeze is where the Bollinger Band becomes very, very narrow and the price is in a very thin range, especially if it's a bullish stock and RSI is low. You go long and they should rise. So I'll just see if I can show you something like Apple, for example, with the Bollinger Bands here. Yeah, with Apple, there's not really a lot of squeeze. I just want to show you a squeeze example, maybe with Tesla, because that's a volatile stock. Here, that's perfect, right? That's a Bollinger Band squeeze right there, or right there. See, right? When the Bollinger Band squeeze, right, gets narrow like this, up and down, is like also this is like your triangle breakout pattern as well, because you can see this, and this is a triangle, right? This basically, I'll just draw this, right? So from here to here, and then from here to here, and then from here. This is your bullish flag pattern, right? This is your bullish flag, and then like when the price gets wide and then narrows, and especially if it's a bullish instrument and it's a bull market and RSI is quite low, you go long. It usually breaks out. This is the typical flag breakout. Which I like to trade. I like trading these breakouts a lot. Again, I'll show you these sort of we'll cover in another section later. Typical patterns, right, or trading patterns such as your bullish breakout, but bearish flag, double bottom, double top, head and shoulders, reverse head and shoulders, and all that stuff, right? We'll talk about. Or there's it gets even more complicated. Like there's like your butterflies, there's your shark, there's the bats, and all these kind of patterns, right? We'll talk about that as well in a separate section on patterns, right? But right now I just want to finish off on the indicators on this bit. So basically that's that's quite a nice one, because that's a Bollinger Band squeeze. Your Bollinger Band becomes narrow and then it shoots out. So that's quite good. But personally, I actually prefer, let's say if we go back to the US 500, I don't really like Bollinger Bands as much. So actually, let me just show you the Keltner channel first. So if you type in here again, Keltner channel, it's quite similar to the Bollinger Band, but a little bit better, I suppose, because you see it doesn't stretch as much. The price is outside. So if the price is outside it, you wouldn't go in long yet until when the price goes back inside, and then you go long, and then that's quite, that is better in that perspective, right? See that crash there, right? The price went back in, you would have gone in there, but if it goes back out, you get out, so you lose small, right? Whereas the Bollinger Band follows it too tight, and then you don't go in until the price goes back in again here, which it did, and that's where you go in, and then you go long. So the Keltner channel from that perspective is actually better. Again, if it's over spot, you short, it's going to go, it should drop. If it's oversold here, you go long, it should go good. Although on a stock like let's say you're trading bullish stocks, I would only go long. I might not take the shorts, I'll just take the longs. But on the US 500 is okay, you can go take shorts and longs. Although it's still better to go long because the overall trend is still long, as you can see. So yeah, Keltner channel arguably is better. But I actually quite like this one here, which is the LRC. That's your logarithmic, linear regression channel, right? So that's your linear regression channel, right? See, it's a little bit better because whenever this one's just more accurate. See, look, this crash went out. If it goes here, you go in, or as soon as it goes out, you take a tiny loss. You wait all of this period out until when it goes back in, and then you go long, right? You don't have to you don't have to think about all of this crash because it's not inside the band. Just let it go because it should crash more. and then when it re-enters the band, that's when you get in. Again, see, look, when it touches the top band, it tends to retrace again, but this one went outside it. So if it goes outside it, leave it, let it go, comes back. Again, because this is bullish, you want to go long instead of short. So you see how the middle bit of the band tends to get respected a lot. So it retraces to the middle, and then you go long, retraces to the middle, go long, retraces to middle, go long. This one's now in the middle, so it might go long soon as well. So I quite like that, but it doesn't mean the middle will always hold. Sometimes it might go to the bottom. So I prefer this band a lot. So if you look back at history a little bit back here, so right there, again, band goes there, retraces. This one went to the bottom. You see that? But you want to wait for the bullishness. So this is bullishness, goes up to the middle, goes up to the middle, up, just below middle, up, middle. See, the middle one tends to hold. If not, then the bottom one usually holds, apart from a crash. But the middle one during a bull market has held quite nicely. So you could start adding. So let's say the market's correcting, you leave it until when it touches the middle, then you add your initial position. Starter positions, right? Or you could use your EMAs and you could use your RSI, right? I'm teaching you everything here so you can then combine the indicators and the strategies that you prefer. So you trade in your own way, right? So again, in the middle, add starter position, and then here you would add starter position now. Even though the market's correcting, you add starter position now. If it goes lower to like 3,500s, I think 3,500 was strong. We're pretty highly likely to hold at the moment, at this moment in time with the US 500. It's just it is an expected retracement, a healthy pullback. This is almost expected. I anticipated this a week beforehand. I anticipated this one a week beforehand as well, because you can sort of see it from the chart. It's okay. I started adding sort of here, and I added more here. If it drops to there, that's where I'll add my fine. If it doesn't drop to there, I don't need to add more. I've got positions anyway, stock positions, I mean. So you combine that along with this, it's quite a powerful. I like this channel a lot. See, when it goes near the top, it retrace, so, and it tends to go to the middle. So you can start adding in the middle, and if it goes lower, you add more. So I like that. So that's the LRC. So if you go here, type in linear regression. There, linear regression, right? Linear regression channel is either this one or this one. So and just make sure it looks like that. So that's that. Make sure it looks like that. So that's that one, and there's another one which I really like too. It's not a common one, but I quite like it. It's called the logarithmic trend line, right? Logarithmic trend line. Again, you go here, you just type in logarithmic trend line. You just type that in. I think this is wrong spelling, that's why. There we go. This one here. Right? It's not very common, as you can see, but I quite like it. You can see if you go on to weekly, for example, on the US 500, you see how the top line is overbought, middle is middle, and bottom is oversold. You see how well this is respected on the top, right? You see how on the weekly, if the price of the US 500 touches the top, comes back, retraces, right? So that top line is very much highly respected, especially if it's top and then the RSI is like 90, which it is over there. You just don't buy stocks, right? Because US 500 is your index for your stock market. So when that's so overbought at this level, and when the RSI is that level, it's bound to do a correction. This move here it's so expected, because not only did this price on the weekly touch the top logarithmic regression, right? Also, but your RSI is 90 something. I mean, what was that? 90? I'm sure it was about 90. Yeah, 90. So that's super expected, that kind of a correction there. And then here again, your band touches the top. RSI is not 90, so it's not as expected. But at RSI 70 is kind of expected as well. But anyway, because it's touched that, and you'd expect a little bit of a correction. So that's quite good as well. In fact, this band works not just on the US indices; it can work on other instruments as well. Even on the daily, if you go to the daily, You see this is Tesla, right? Tesla stock. See what happens here? Goes just a bit above it, boom, drops. This is daily, remember, right? Not weekly anymore. Drops, retracement. Touches it, like literally just touches it and retraces. Touches it, retraces. This is on daily, right? And this didn't even touch and it just retraced because there's a market correction, right? But again, it might. But look what happens when it nears the bottom, right there. Touches the bottom, goes back up. Touches the bottom, so I anticipate this to maybe go back up soon. Same with AAPL. So that's why I like this, right? It's not a common one, but I like it a lot because it's quite accurate. This is Apple. So look, touches the bottom, goes up. Touches the bottom, goes up. Breaches the top, not by far, comes back down. Now is at the bottom, so probably go up. Sorry. So what else? SGen or whatever. Just pick any stock. Again here, look. Respects the top, like sure it didn't reach, but it's not far. And that one reached and came down. This one's on the bottom, should go up. This one's on the bottom, like breached the bottom, not by that far. See, it doesn't breach it by that far, and it goes back up. So you know, anything you could use this for a lot of instruments, and it tends to respect those kind of levels. The middle bit, see the middle bit, see how this is gold and it wobbles around the middle, goes to the bottom and comes back up. It can't go too much below the bottom unless if it's a market crash, of course. Then it can go more. But so just want to show you a bit more. Maybe with Mara. Let's just check Mara, which is a Bitcoin mining company. Again, see, look, it works with pretty much all stocks. The middle section respects price, right? The top section respects it. Price respects the bottom, respects the middle again, respects the top, right? So this is quite good. It gives you a bigger picture of what might happen, which is this band. I actually use this for the US 500 quite a lot. You know, anticipate what move is going to happen. So by combining this band for the US 500, you know, seeing the weekly and the daily where the level is, and by having this band and as well as this band on the daily, you know, when it's on the top, we'll do a retracement to the middle. You can sort of work out or anticipate what kind of a move might be expected by the market. And then if you look at the VIX as well, you know, the whole thing together, you know, I hope you're starting to see how you can fit all this together and really become a more effective and profitable trader. Thank you guys, and come back for the next video where I'll show you even more indicators and more technical analysis. Hey, welcome back. Again, hope you're enjoying the course so far, and here's more value, here's more indicators and more technical analysis education for you guys. So wanted to include this. So we've already touched MAs and EMAs, simple moving average and exponential moving average. So we kind of already gauged that. I just wanted to show you one more indicator which is to do with that, which is called EMA crossover strategy for beginners. If you type in beginner, you can see it here. You click on that, and basically that's your two small MAs, EMAs. Whenever you can trade them hourly or whatever, you know, I'll trade long with it. You can do daily, hourly, whatever you wish. So basically, I only trade long on bullish stocks with this. So I wouldn't short. Again, shorting is more risky. If you know what you're doing, is fine, but if you don't know what you're doing with shorting, it's really risky, as I've said. So basically, this strategy is whenever your MA, the lower MA here, crosses above the higher MA, you go long here, considering, well, you should have an RSI on as well. So have an RSI on, and considering your RSI is good level, so that's quite good for Tesla, actually 50. So you enter long and you will hold it for as long as until another dot comes. You see how this dot comes up when a bullish over crosses like that. It also a different dot comes up if it crosses the it just if it crosses. Basically, every time they two cross, it comes with that. But that's a bearish cross. You got to compare that. And this is a bullish cross. So you would only go bullishly on a bullish stock, and you would go here and hold it all the way until they cross touch again here, and that's your sort of profit there. Again, you can maybe again you enter here, get out here, or you can enter sort of here if you want. ride it all the way and get out here, right? And that's quite that's quite a good strategy in itself. And this is your longer term MA. I think that's your 200 MA right there, which is again a part of the beginner's strategy. So so in fact, let's just check. Yeah. So yeah, you see. So basically, that's probably your 9, and that's probably your 20 MA. That's what you're trading with, the beginner strategy. Yeah. So your 9, you're on your 20, and then you got your 200 there. So yeah. You can trade that. And another one I want to draw your attention to is probably the choppiness index, which can be useful, especially using a strategy like this combined, because this strategy, when you have consolidation periods like that, is really, really annoying, because what can happen is like they will, in this case is okay, but sometimes what happens if it's too consolidative up like that, they'll cross up, down, and then you get a lot of false signal. You get like here, for example, you can get some false sort of signals all the way there, right? But if that's the case, especially for a stock like Tesla, considering the RSI is good, you might hold through here. You might not exit yet. Just hold it, unless if it drops big time. Just hold it, and it should go bullish because it's Tesla. It usually turns bullish. Depending on the stock you're trading, NEO, Tesla, Apple, Bitcoin during a bull market, these are all okay to go long. I mean, sooner or later they're going to turn green anyway. But the choppiness index could be useful in the sense that, so the choppiness index is basically this one here. Whenever you see how there's a gray zone in the middle, whenever this line is above that upper zone and in the white, it suggests that the price will likely consolidate for some time. So if you just look, see, this is above it and price consolidates. This is above it there, price consolidates. This is above it, price consolidates. But when the index does a move, so here it is. So when the index doesn't move like this, right? The only thing is this index doesn't follow. It's not like your RSI, because your RSI goes up as the price goes up. RSI comes down as your price goes down. But this, even if it comes down, all it is if it's a sharp down move, all that suggests is that it's a sharp move either up or down in price. It can be up or down. It doesn't have to be down. It can be up. So in this case, it's up. But your choppiness index also came down, right? So as you can see, that's a big sharp rise, and then it goes here, and that's where, and then it sort of consolidates a bit. So whenever it gets close to the if you're relating it to the RSI, when sort of overbought range is, although it's not really overbought, it's just the choppiness index. Whenever it goes to here, like up there, like see that above that upper line, or goes close to that upper line, price tends to consolidate. And then when it does a sharp drop, that's when the price either drops or rises. So you could combine a choppiness index or your Williams percentage could work as well, along with an EMA crossover strategy. They two might work quite well together. So I thought I'd show you those two indicators, which are pretty good. So yeah, next one we have. Let me show you we'll just take this one off, and we'll take this one off now because that's over, and we'll take this one off. Let me show you now the Fibonacci stuff, right? Fibonacci retracement, right? So if you don't know Fibonacci, you can look into it. Basically, there's so much, Fibonacci is actually really, really, really interesting, even in real life. A snail, the shape of a snail is Fibonacci. There's like certain shapes are Fibonacci, just basically numbers and levels, certain respected levels, right? But in trading, Fibonacci levels are basically respected levels whereby the price is likely to either retrace or consolidate or rise above or sort of react to those levels. The price will respond to those kind of levels, right? So if you just do Fibonacci levels, for example, right? So that's the indicator called Fibonacci levels. You can have that, and basically at each one of those levels, the price is likely to react. because these are all your Fibonacci levels. So that could be a good one. Or if I draw your attention to here, if you click this one and you make sure you are on the Fibonacci retracement, Fib retrace right there, right? And if you want to find out your Fib levels, you can do from the low to the high here, and then these are sort of your Fibonacci levels. But you got to make sure it's quite accurate there to here, right? So these are your Fibonacci levels. Price tend to consolidate at each of those levels. See that at this level, it tends to hesitate a little bit, and then here you see that it went there and then came back down, and then at this level held and it consolidates there. Again, this level is quite so it's quite if you see this level, it's quite respected, and this level, you see that exactly hits that top Fibonacci, starts to come down, and here it consolidates. Here is at that Fibonacci level, maybe it will start going up, you know. So these are your sort of Fibonacci levels, which are very well respected in trading. Fibonacci levels. And then you have, so if I just take that off, you basically just, with that Fibonacci, you just drag from the most swing to the low, then from the low to the high of the recent swing, and then you know the Fibonacci levels in that region. From here you drag it from the low to the high, then you know the Fibonacci's in that region. It tends to react, price tend to react to Fibonacci levels. Kind of like your support and resistance as well. You can have your support and resistance as well, which then the price tend to respond. So this is another. So these are all your Fibonacci levels. Fibonacci level here, Fibonacci level, Fibonacci. So these are all sort of these are Fibonacci zones. These are working out for you automatically where your Fibonacci zones are. So this is a level, that's a level there, that's the next one, that's the next one up, that's the next one, and price will tend to respond to those levels. So you can play around with the Fibonacci stuff as well. I personally use Fibonacci myself sometimes for my trading. So if you swing it to this high here, for example, you got your level here. This is your Fibonacci. You see that? Look, all I did was drag it from here to that level, but you can to the high, right, to that most recent high, to the low there, and you can see how that level gets respected a lot, and then this kind of level gets respected, and and this level, see how this level gets respected, goes down, up, goes down, touches it, goes up, down, touches it, and then it rises above that level. So yeah, play around with Fibonacci levels. They're pretty good, and again, there's many Fibonacci. So you just look at it and choose one which you like, or Fibonacci that, or Fibonacci cluster. There's just loads of Fibonacci stuff. Right? I don't really like this Fibonacci cluster one because it's just so messy. It doesn't really work. But these are quite good as well. Fibonacci bands. So up to you. Like, just play around with it. Take a look at the Fibonacci stuff. It's pretty good. And so that's that. So we got the choppiness index. We covered Fibonacci levels, and we covered the EMA crossovers for beginners. And you could utilize those and see how you want to trade with those. Thank you guys. Happy trading. Hey, welcome back. So we've covered so much in this course already, so many indicators, so many strategies actually, because each indicator can be used as a different strategy. Many strategies and many indicators. But hey, there's more to come. So this one, I'm going to talk to you about VWAP in this tutorial. So VWAP is volume weighted average price. Basically, it works out the average price point throughout the day based on your volume and price. It's more of a scalping strategy. I wouldn't really use VWAP for like long-term trades, like for example 4 hour or something, or 1 hour. Just wouldn't work. It's purely a scalping strategy. You can use it for 5 minutes chart, or you can use it on a 15-minute chart. I personally like using it on a 15 minutes. Again, like I've said, I think since the beginning of this course, I don't like trading 5 minutes or less. The only scalps I do are 15 minutes minimum. I don't do anything less because it just takes too much time, too much effort, you know. And to be honest, not that much move you can catch. You're just trying to catch a tiny movement, which is okay. It suits some people. I mean, and sometimes, and on the 15-minute scalps, sometimes I do quite a lot of them, but like sometimes I don't, not because it's not profitable. It's actually highly profitable if you know what you're doing, but it's just so much attention needed and so much energy required. You need to sort of stare at it. So yeah, so 15 minutes VWAP. So in fact, let me just make the VWAP. Probably be better if the VWAP is a little bit of a different color so that you can distinguish it. So I'll make the VWAP red, and this is your moving average 200. This is just a simple moving average 200, right? The blue line, and the red line is VWAP, right? So basically one of the strategies you would trade VWAP, whatever instrument, I'm just using gold here on the 15 minutes. Again, VWAP, you can't use, it just wouldn't work if you use it on daily. There is no VWAP. It is a scalping strategy. So basically how the strategy goes is that, so let me just go to the right bit to show you. So let me try and show you. So let's just show you here, right? So basically, whenever the price is below the 200 moving average, 200-day moving average, it is bearish, right? It is a bearish trend. And when the VWAP tests the 200 moving average and crosses the 200-day moving average below the price, right? The price goes below, you can short it. Right, you can short the instrument, and you can, even that move on gold is actually quite a massive profit depending on your position size, right? Because if you're trading gold, you're going by lot sizes. It's a CFD trade. You'd use a platform such as IC Markets or Wanda or FX Pro, FXCM, or a platform similar to that to trade CFDs or forex. I personally use IC Markets because I really like them. They have super high leverage, really good friendly customer service, highly professional, reliable, trustworthy. So I love them. So IC Markets, I can include a link in the description area as well if you like. I'll do that actually. So basically you would short this. When that crosses, you can even take a profit here, or at least take partial, or you can ride it all the way for as long as this VWAP stays below the 200 MA, and whenever it touches it again, that's when you would sell. You might probably sell here because that's close to touching it. So that's a pretty massive profit there. Again, here crosses below, you can take that trade and sell here. That's another move. If you go back, but you would only short that because the price is below 200-day moving average. Also, the trend is downtrending on gold just now. So you basically when you're trading, right, trend is your friend. You want to trade with the trend, ideally, most of the time. If you're efficient, if you're good, you can go against the trend as well. If you're really good, but you must be very good. You must know what you're doing, and you would target for less. Your TP should be less, and you should always have risk management in place, especially if you're going against the trend. Ideally, you want to take with the trend trades with any of the strategies I've just covered for you. The trend is your friend. You want to trade bullish stocks or bullish instruments during a bull market without chasing, entering at the right time, and take partial profits along the way. That is the way to profit in this game. So let's see. Okay, so this is a bullish momentum now. So the VWAP now crosses above the 200-day average. So that's a bullish momentum. So what you do there is you long the stock or instrument. You long it until the VWAP cross again, so you catch that move there, right? Again, this is a short. You short there, you catch this move here and get out there, right? Again, you can use your RSI to back these up and stuff. But again, the VWAP is a scalping strategy. Is more of a on shorter time. It works on the shorter time frames. So again, you could long here, carry it there, and then get up there, and make a small profit there. Or you even enter again here, and that's a pretty massive profit there you could have made. So it just depends. And then the VWAP crosses here, you would have got out there. You wouldn't hold through all of that. There's no point. VWAP already crossed on below the 200-day moving average. So this is quite a nice simple strategy to follow as well. You've learned a lot here. You might be able to figure out something that I don't know. I've never tried, based on everything I've taught you, you probably figure out the combination of everything together that just gives you such a high win rate. But I hope you can see with these indicators, with this knowledge, you are going to be a much better trader. You're going to know your entries better. You're going to know when to exit, when to exit the trade. You're going to know when not to chase. You're going to, you're just a better trader overall based on all of these strategies, right? And there's a lot of risk control, right? So for example, a move here, if it crosses here, you're going to take a profit, take it and leave it. You're not going to hold, and then you're going to lose. Your entry was here, or let's say your entry was here, right? You're not going to enter here, hold there, and then hold all of that, and then lose that much when you could have bagged it here, right? And then wait for the down move, and then enter maybe here. So these are useful information because then you don't know when to enter, when to exit. You might have just hold all the way through, hoping for it to come back. But what's the point in holding all of that when you could have bagged profit there? So that's VWAP, and that's combining VWAP with your 200-day simple moving average to trade scalp any instrument. Ideally, you want to go with the trend, so trade with the trend. So that's that, and beautiful. Let me just finish this one off with a unique indicator for you guys, right? This is a Actually, I'll talk about the unique indicator in the next section because it's just better. It just makes it simple for you guys. If you just want to go back to that unique indicator, you can go back to that section and you're going to be able to cover that and that. I just think that's actually a better way to do this. So I'm going to do it in the next video, and be sure to come back to the next video. These indicators which I cover in the next video, you do have to pay for them, but they're very, very valuable and they can give you certain information which the other indicators may not be able to give you. I find them to be highly effective. So do check it out. Happy trading. So I thought I'd include a few more actually indicators for you. Again, there's just so many indicators, right? I've covered throughout this course. We'll probably cover more than 20, maybe even 30 indicators, more than 20 for sure. And you decide what you wish to use or utilize yourself. I mean, everybody trades a little bit differently. So on top of that. So have a look at another indicator here, which you can scalp with, is a scalping indicator. Scalping is where you day trade for a quick move and catch it, and that's the end, right? Swinging is, just in case, just to get the definitions, probably should have explained this in the previous courses as well, for the beginners. But basically, a scalp is a day trade or a quick trade in and out. And an intraday trade is a trade which takes maybe 1 or 2 days or within a day, and then you have your swing trades, which takes a period of time, maybe a few days to a couple of weeks to even a couple of months, and then you have your long-term hodls. So this one is a scalp trade. I would use this on the 5 or 15 minutes. Even 1 or 3 minutes is okay as well, but it just depends on what you like. Personally, I never scalp less than 15 minutes. It's just too much work, too much focus, too much concentration. But 15 minutes, I do scalp sometimes. So basically, what we have here this is a strategy. You can use your EMA crossover strategy R, which is a beginner strategy. If you just type in beginner here at the thing, and it'll come up here, EMA strategy for beginners. If you keep that, and then you have the VWAP standard deviation bands and the support and resistance. To be honest, you probably don't even need the support and resistance because you're scalping off such short time frames, but you can have it on if you want. And then you probably have you wouldn't even need that. Probably just have an RSI or maybe have the other one on as well, but have an RSI or a Williams percentage or something like that to combine with this. So that's that, and volume as well if you want. So the VWAP standard bands is basically you just type in VWAP, and then a lot of them comes up. So it's the VWAP, this one here, VWAP, this one here, sorry, VWAP ST Dev bands V2, or the normal one, either, oh sorry, this one, yeah, V2, sorry, it's got to be the standard deviation. So VWAP standard deviation band 2, right, version 2, right, that's the one I have on anyway, and then it will look like this. So basically, with this strategy, what you can do is a scalping strategy, and what you can do is you look out for RSI, or if you want, maybe a Williams percentage might work better with this one. So maybe have a, sorry, so maybe have a Williams percentage on instead with this one instead of RSI. You know, up to you, play around with it. So basically, with this strategy, just like our original strategy, right? Which I've already showed you with the VWAP, except there's just one VWAP, remember? So you don't really even have to have the EMA crossover if you don't want to, because it might mess things up, but you can use it. So basically, the EMA crossover is when the lower EMA crosses the higher EMA, you scalp, and then if it crosses the other way, scalp the other way, right? But basically, the strategy is that you must have. But even if you don't have the EMA, you must have an EMA 200. So I'll just switch it on for now. So the EMA crossover strategy is 2 lower EMAs plus the EMA 200 or an SMA 200, either one. Have either an SMA or an EMA 200. You need this for the strategy. And basically what it says is that you will look at, for example, here when the EMA crosses and then the VWAP, right? So basically the VWAP, the 3 VWAPs are those lines, the red line there, the red line here, and then the VWAP, the normal VWAP is this green line in the middle. This is your normal VWAP. If you just had VWAP, that would be the line there, right? So basically, whenever the VWAP tests the EMA 200 there, you then short it. You short because it's a downtrend, right? So because if the price is below the EMA 200 or SMA 200, it is downtrending. So you would only short instruments that's below the EMA 200. It's just safer that way. So let's say, look, there's a crossover here. Let's say you shorted it here because that's below the EMA. You would carry this all the way. You just decide until where, until this thing crosses the EMA on the above. Then on the EMA 200 there. Then you get out and then you take a profit, right? And then you double check this by using a Williams percentage to see if it's overbought. You want it to get in. You want to get in at a point where the Williams suggests is overbought, which is about here, right? You get in right there, especially it is overbought and it's touching the EMA 200 and the VWAP is falling below. You take it and then you just short it, right? The reason using this strategy is because these act as bands. Instead of having one single VWAP, you have almost like a band thing. So because this band acts as overbought and oversold, which is quite effective. So if you look at it, if it's touching the bottom VWAP, it's oversold. If it's touching the top VWAP, it's overbought. So it might help you with your timing. So you might, even better. So play around with it. So basically, what this strategy can be done is if it breaches the lower VWAP, you can long it. If it breaches the top VWAP, you can short it. But the way how I like it to use it is to use it along with the Williams. If the Williams percentage says is overbought, this is and then this and it's near a VWAP, and then it breaks below the VWAP. You enter just on the candle that closes below VWAP. You enter at the top of this candle, and then you short it until it breaches above VWAP. But don't set your stop loss on the VWAP. You can set a stop loss with a few pips above the VWAP in case these kind of false moves take you out, and then you missed out on the whole of this ride, right? This might have taken your stop loss off, but if it does that, what happens, right? If it falls below it and consider the Williams is high, you take another position here, short it more, right? So that's how I would do it to keep the risk low and to keep the reward high. So it's actually a really, really effective strategy, this particular strategy, if you use it correctly. The VWAP together with the MA 200. Together with the Williams percentage, I actually think this is quite an efficient strategy for scalping anyway. But again, I personally don't really like scalping, so I swing more, so I use my other indicators, because VWAP is more of a scalping indicator. So that's that one. I suppose I'll touch one more with you. I don't really use this that much, but you could use a commodity channel index, the CCI, which is this one here. Again, that's sort of your overbought, oversold. You can use this to combine this as well. See, look, if your CCI is at the bottom here, it's considered oversold. Should go up a bit, and if it's at the top there, above this, anywhere, basically, see how there's a gray area? Anywhere above that is considered overbought. Anywhere below that is considered oversold. So, you know, again, is probably useful. Maybe you can, you know, use it, but I don't really use the CCI too much. I'm more of a Williams percentage, stochastic, especially the special stochastic, which I showed you, which is a little bit better than a normal stochastic, I think, and then RSI Divergent, especially the divergence of RSI. These are the sort of indicators I prefer myself, but you know, up to you. So that's that. I hope you enjoyed that. That's a scalping strategy in itself, to be honest. And of course, if the price is above VWAP, which is here, sorry, not VWAP. If the price is above MA200, it shows is a long-term is uptrending, right? And then this EMA crossover crosses here, right? And then you look at the here, the Williams, and it's oversold. You enter long here, right? And there's many ways to get out, right? There's one way to get out is you enter long here. Williams is now overbought. You get out there and you just bag that profit, and that's it. And then you leave it. And then again here. This is Williams showing oversold, and then you got to see where your VWAP and stuff are. You know, that might be a bit too far away from your MA200 to catch another move. You want to be catching it sort of near your MA200 kind of level, and you would long it if it's above it, and you would short it if it's below it. So here, for example, this is a nice move here. See this right there? This is the kind of move you want to be catching right here. See this? It's touching there. This is oversold. You buy it there. Even just that move is plenty of profit, or you can carry it further. Okay, guys, thank you and happy trading. So welcome back to another section. So this section is quite exciting. These indicators are really quite effective, and really quite unique. They're highly unique. A lot of traders probably don't trade with these, but I find they're very effective. Again, these indicators that I'm going to talk about only work on the MT4 platform, which is your MetaTrader 4 platform, and two of them are paid. Actually, you kind of need to go to a company and purchase it. It's completely up to you. As you've seen, I've showed you so many indicators already so far, probably 20 indicators plus, more than 20 indicators which I've already shown you so far, which are all part of the TradingView platform. So that might be sufficient. So you don't really need to get these, but I think getting them gives you maybe a little bit more info, especially when it comes to US indices or global indices, if you like, or any other instrument that is tradable on the MT4 platform is useful to use this, such as your VIX or your XAU, the gold or silver, or any other index, or UK index, even BTC, ETH, to check what's the sort of imminent move that's going to happen, or any forex pairs, your oil, anything that's available on the MT4 basically. So basically the indicators that I have here, I'll right click it, I'll show you indicator list. I have the Scott Pro Zone and the Scott Pro Band and the SFI, right? I'll just draw your attention to them. So the Scott Pro Band is this here. See the red band on the top and the green band on the bottom? That's your Scott Pro Band, okay? And your Scott Pro Zone are those levels, right? DR1, WS1, DS1, all these, that's your Scott Pro Zones. What they stand for is daily resistance 1, monthly pivot, weekly pivot, daily support 1, weekly support 1, daily support 2. Basically, it's all automatically calculated. They know where all the resistances for the days are, for the month, for the week. They know where all your supports are for the day, for the month, for the week. Everything's all done automatically for you. And then you got a band which is which the algo calculates at a specific level, that if such an instrument goes and touches the band on the top, means overbought and it'll drop. Kind of like your Bollinger Band, but like 5 times better, because it's just much more accurate, because Bollinger Band will just follow it in wrong ways, and then it looks ugly as well. This looks pretty, and it doesn't follow it wrongly. It gives you a cross whenever it thinks you should go against. When the trend is over, you should go the other way. So for example here, you got a cross here. Even if you went in there, if you held some red, it would have gone back up. You see, this is your this is your US 500. Again here, it touches the band on the bottom. It thinks this is trend is about to return with a cross, so you go up and you're going to long it. You're going to win it. So that's that indicator, and then the SFI indicator is this one here at the bottom. Again, these indicators you have to pay. These indicators you have to pay for them. You buy them through a company via a company called Sinri Advice. Right, I'm going to include a link in the description area of this section of the course. I'll have a description. I'll have a link to the company. I will also include a discount code which I've negotiated with the company. You will be able to receive a 10% discount code if you use my discount code MAGICYIN. So if you just use my link and use the discount code, you're going to get 10% discount off all these indicators. You can look at them. They're not that expensive. Scott Pro Band it's about $40, no more than $50, and the SFI is no more than $60-70. Both together is, I can't really remember, it's about between $100 to $150 for everything here, which is okay. It's a one-off payment. It's not a monthly payment. There's loads of stuff out there like break free trading or alerts or groups, etc. That or it's just so much, or signals, elite signals, etc. They charge, like, we're talking $50, $100, $200, sometimes more per month just to be a part of that service, which arguably isn't even as good as these indicators. These indicators give you a higher win rate, actually, because I've been with break free trading, I've been with these other people, and you have to pay them monthly, and the win rate is actually lower than what these indicators provide you, and these indicators give you a higher win rate and is a one-off payment. So I think it's worth it. So I went for it because I trade pretty much like full time is kind of what I do, and I trade all financial instruments, and I find this to be useful. So this is your SFI. Basically, whenever the SFI arrow, sell arrow comes up, the price is likely to drop like that. For example, here you would have sold there, and look, the price drops. And when the next arrow green comes up, that's when you sell. You would only take them at the top. So this sell, I might not have taken it because it's in the middle. You take the sell at the top, you take the buys on the bottoms. So, and also try to go with the trend as well. You got to go. You're just more likely to win, to beat the market if you go with the overall trend. So again, here, this is at the top. You combine those two together. So look, this is at the top band. This is telling you to short. This is telling you momentum is returning. You then short that market. You catch that move. Again, here, I wouldn't have longed this one because I might have, but a smaller position, because the trend line's holding the price up, which might made me go long. But because it's nowhere near the bottom band, it's sort of in the middle of the band, so it's not as safe. I tend to take ones that's like this. For example, here, right there, it's broke out the band. It's got a cross to tell you to go long, and then this tells you to go long. You enter here and go all the way. So you combine those two together to to make a highly accurate prediction what's going to happen to the market. And that's just your US 500. But if you look at your DXY, you can use this for every single instrument on the MetaTrader 4 platform. So again, here, it did touch the band. Even though there's no cross, I might go long and just catch some of that move. Here, this one here touched the band, goes long here, and catch some of that move. It's just basically that's the idea. So I quite like these indicators, and I actually have a course called How to Win 90% of Your Forex Trades, which I actually basically teaches a strategy which I use on the 15 minutes. You can use it on the hourly as well. It's up to you what you want to use. 15 minutes is more of a scalping strategy. In that course, I teach the scalping strategy on the 15 minutes. But if you want, you can trade off the hourly and swing it. It's just completely up to you. Basically, this is what I use. I use all of these together, and the win rate's super high. I would say 80% plus, more than 80% win rate, 85% I would say overall over the long term. So it's quite consistent. To win 80% plus of Forex and CFDs is considered a good win rate, 85%. And these indicators can give you that. But you can trade anything with them. You can, like, that's on the MT4, Forex CFDs, or indices, or ETH, some cryptos. Just whatever you desire, really. So That's that. But in addition to those, I also have a few more which I find helps, and that is the auto trend line, the easy supply demand, right? Which are those two, right? Auto trend line and easy supply demand. I find that helps a little bit, right? Your auto trend line is this. See this blue line here? That's an uptrend, right? And then if there was a downtrend here, for example, here, see this brown line here, this one here, that's your downtrend line. You see that all the way here, right? That's your downtrend holding down, and this is your uptrend, right? And when they two do that, this is a flag. You see, this is a pattern trading, which I've been talking to you about, and come back to the next bit where I actually explain to you how to do pattern trading. So you can see the price consolidates, and once it does that, it will break out one way or the other. In this case, it broke down the way, right? These trend lines just gives you an idea, because without even looking, you know which way, which direction the trend is, right? Because this is downtrending, it's telling you to downtrending, right? Because of that. So yeah, combining them together really good. And the supply demand zones, right? So this one here, which is your easy supply demand, that's a really good one as well, because that's these kind of levels here, all this. So as you can see, here, these are all your supply demand zones. What are these zones? These zones are respected levels, right? Supply and demand. If the price drops to there, it's likely this will hold as demand. Price will go up. Price goes there, it's likely to respect it. Look at this. See, it respects and goes up. Price touches that, it might respect and come down, or goes up. It doesn't mean this will definitely hold, but there's a chance. And this one, again, if it touches that, it might come down, right? It doesn't mean they will definitely hold. But look, see this level? Price tries to breach and it respects and it goes down, right? And this is support, trend line support, holding the price up. Again, the price goes up, touches that and respects it and drops. And again, this is your other supply area. The price goes up, touches that, it couldn't breach above, so it drops. Again here, this is a bit of a supply level. Price goes up, touches that, it couldn't break through above it. It doesn't mean it definitely cannot, it will always respect it, right? But it gives you an indication that there's a chance when the price goes here, it's going to hold, right? So if you're in a trade, it gives you an idea what to do with it. Again, sell that. There's a little bit of a demand area here which held the price. So you probably, let's say you shorted that, you probably would close the position there because it's now holding, there's a bit of a demand there holding, and then you go there, right? Again here, this level is supply demand level. Price goes there, comes down, touches it, and then goes back up, right? So these supply and demand levels kind of guide you what might happen to the price once it reaches that. So maybe you can take a profit there, you can cut your loss there, or whatever you wish. So I think these are useful levels. So basically, by combining all of these indicators together, I think you can trade quite effectively, and you can quite accurately predict what might happen to something. So for example, the US 500, if you look at it on a 15-minute time frame, I just want to explain to you, right? If you look at it on a 15-minute time frame, you can see this indicator here is quite exhausted and it's starting to flatten. And this is at DR1, or even if it does go up, I think this zone here, which is a support, basically a resistance or the supply demand zone. So in this case, will be supply zone. So it might actually drop from there, right? But at the same time, this area here might hold up as a demand zone and push the price up. But this is starting to look exhausted, so the price may fall soon. And then if you look at the longer time frame at H1 hourly, this is only in the middle, so arguably this could go even more up. So it looks like it might head towards this area and start to come down, or it might even go up to this sort of supply zone and then come down. Although this demand zone hopefully will hold the price up. And then you look at the 4 hourly. from here you can see 4 hourly is only just starting to rise the price, so this could rise more towards that supply zone before it does any retracements. So if you're in the position, if you're in positions in the trade, you then, if this goes up here and touches that, that's where you would get out of your stock trading positions, considered in profits, because then the US 500 might then start to dip, and if it does that, then your stocks will dip. Most stocks tend to dip. Basically, your stocks follow your US indices. If the US indices is a bull market, the stocks will go up. If the US indices drop, which means it's dropping, is bearish, then your stock prices will drop, right? So on the 4 hourly, it looks like it can go up more. So hopefully this price can go up more, and tomorrow, hopefully, today is Monday, tomorrow will be the 9th of March. Hopefully tomorrow we get another bullish day, because there's been many bearish days in the last week or two. And then if you look at the daily, if you actually look at the daily, the sort of downward momentum kind of only just started, but it doesn't mean, look, sometimes what happens is that it starts just a little bit and then it can keep going up, right? So again, these are just indications, but without these indications, you have no idea what to do in the market. But at least if you know these things, it's going to help you and guide you. It's really going to indicate to you how should you go long, when should you go long, when should you go short, combining all that together with your RSI, with your Williams percentage, with your trend line, support resistance, auto trend lines, with your MACD, stochastic, with your divergence, with your EMAs, with your Supertrend, with your buy and sell signals, with your bands, the logarithmic bands, and your linear regression channel bands, the whole thing. If you put the whole thing together, it then starts to become really clear, and you start to have a good idea and understanding for all financial instruments out there. Thank you, guys, and come back to the next video, because I think next video I'm going to include a bonus section which teaches you a few indicators which you can use to trade cryptos and Bitcoin. Specifically use them for cryptos, which might be quite useful. To be honest, you can use this for crypto as well. So this is good for crypto. You can see now crypto is in a sort of a flag, sort of consolidate, boom, boom, boom. It's about to break. You can just tell Bitcoin price, it will break one way or another. Just by looking, because it's just consolidating narrower and narrower and narrow range, and a boom is going to break up. I think it's going to break up the way, because Bitcoin, what's been happening is that it just consolidates, and every time after a big correction it consolidates, and then it breaks up parabolically. Especially this year after the halving last year. Sorry, the halving event was last year. After the halving for about a year and a half, the Bitcoin tend to rise quite heavily. So yeah, thank you guys. Come back for the next one, and happy trading. Hey guys, welcome back to another video. So this is a bonus section showing you another indicator. This is so these are specific indicators, if you like, which you can trade Bitcoin with or cryptocurrencies with to see sort of when it's overbought or when it's might likely to do a retracement, and whether it's a bull market, bear market, etc. Right? Now don't get me wrong, you can trade cryptocurrencies like Bitcoin and your altcoins using everything I've showed you in this course, based like off those bands or off those RSI levels, super overbought, etc. I've already taught you all that. But in addition, specifically for cryptos, I wanted to include these additional indicators which are for Bitcoin only. So this one here, that is the sort of the rainbow colored sort of channel. That is the Bitcoin logarithmic curve zones. Okay, BTC log curve zone. So if you just type in that on the indicators, it will come up. And another one you want is the MA20 on the close, MA20, and you could have this, but you don't necessarily have to. This is more just to get a general picture of what's happening, which is the hash ribbons, right? The Bitcoin hash ribbons, which is so right here. Let me just click on that. Here, hash ribbons, right? Backtest, hash ribbons, backtest. That basically tells you what the hash rate is for Bitcoin, and when basically when it does something like this, it shows there's hash coming in, and when it turns blue, it means that the hash rate is there, and it should bullish. The bull should follow. So whenever this turns blue, there's usually some bullishness. See, look, blue here, and then there's at least a bit of bullishness, and then it'll tell you when it drops back by saying close position order. It will say long here along with this, that means the hash rate's coming in and there's bullishness in it, and then you carry it, and you could close it either at the 20 MA. You see how this price dropped to the 20 MA, you can close it there for a profit there, or you could close it when it says it here. So just it's up to you. So basically whenever this turns blue, there's a chance of a bullishness, which you see there's one, and it'll say long here, so that's one there. And then when it touches the 20 MA, you can get out. And then the second one here, again, you can go in here and ride that. When it touches 20 MA, you get out. Or you can set a 9 MA if you want, and then get out at 9 MA if you want to protect your profit. Again, this said blue, and look at that, that's bullishness, and then you can get out here, and so on, right? So that's the hash ribbons. And then this is the Bitcoin logarithmic curve, right? Or Bitcoin logarithmic curve zones, right? So basically what they are, these are kind of like your algorithm, almost like your Fibonacci levels for the Bitcoin, specifically Bitcoin. Make sure you choose the Bitcoin one, because there's a lot of logarithmic curve or zones, but you want to choose the BTC, the Bitcoin one, because if you see, look, the Bitcoin one would not work for any other instrument. Look, it just wouldn't look right apart from Bitcoin. So these are for Bitcoin specifically. But again, if you want to trade altcoin with it, is great, because all your altcoins are tied to Bitcoin. If Bitcoin does a correction, altcoins correct, most of them anyway. And when Bitcoin bull runs, the altcoin bull runs. So really, the Bitcoin is your main one, is sort of your reserve cryptocurrency, if you like. So look at these levels are highly respected. Look at the daily, for example. We start here. Look at this level. Look, it touched it, and then it reject, and then it'll push through. And then the next level it rejected, and this level then acted as support to support price back up. Price broke above. Before it touches that, it drops. At this level, it's consolidating, right? And the MA20 also act as a sort of dynamic support and resistance. If the MA20 doesn't do that, you add an MA50 to it, add an MA50, add an MA100 and 200 as well to it if you want, right? So basically your 20, 50, 100, 200 are your sort of main MAs. You can add those to it if you want. And look at that drops and then goes back up. Look, so basically look at these levels. See that support level? See that resistance, right? See that support, resistance? See this support, right? So basically this logarithmic band is really good. And if you look at it's really effective for Bitcoin. So if you look at the previous bull run back in 2017, what happens is that I'll just show you the history. So basically what happens is that, and this is the band which I used to come up with my prediction for Bitcoin to hit 100k or more this year. And the reason is because, look, Bitcoin, whenever I leave this blue zone, especially especially after the halving event, but for about 12 to 18 months, or about 1 year to 1.5 years after the halving event, Bitcoin tends to take off and bull run. So basically the last halving event was about this time, and then it took off. When it leaves this blue zone, it has a bullishness, and then you can use this to check. And look, it touched all the way to the top of the band. After that, it went bearish, right? Top of the band was about just under 20k the last time round in 2017. So this time round, if it keeps going like that, in fact, this time round, if you look at the chart, I'm not going to show you like specifically, you can check yourself. This bull run so far is faster and more bullish than the previous if you like, previous bull run, right? It's faster and more bullish by a few months, actually, super bullish. Also, there's more involvers. There's Mass Mutual, there's MicroStrategy, Square, PayPal, ARK Invest, or Kathy Woods. She's very bullish on Bitcoin, although she cannot really invest in it. She's not allowed, although she recommends the ETF. And then there's GPTC. Yeah, she recommended that, and there's just so. And Elon Musk, Tesla, just invested about $1.5 billion a couple of weeks ago into Bitcoin, and then all these companies coming in. So this year I'm actually more bullish in Bitcoin. So if that's the case, if it hits the top, if it hits the top of the band, Bitcoin will be worth $100,000, right? But because it's even more bullish this year, so it might actually go beyond that band to like beyond the top. So that's why my prediction was 100k from when Bitcoin was under 20k. So since Bitcoin was around this level here, just this blue bit, and then so May time was the halving, and then since about September, October-ish, I said Bitcoin should hit 100K. Considering it breaches 20K, which is its previous high, it should hit 100K before the end of this year, which is 2021. And I still think it will hit 100K before the end of this year, as things are at the moment. So, and the way to tell when the momentum has changed, right? When Bitcoin has changed from bullish market to bearish market, is one way to do it is to use the weekly chart and switch on the RSI as well. So let me just do that, or divergence, whichever, divergence indicator or RSI, either one. So sorry, it's a bit slow. There we go. Right there. There's your right for Bitcoin on the RSI. I would definitely change it to 80-20. As you know, if you've seen my if you saw my previous videos, which you should have, I like to use 80-20 for RSI because 70 is only just getting into overbought, but 75 and more is more reliable, and 80 plus is even more reliable, especially for Bitcoin, because there's so much bullishness in Bitcoin this year. For something with that much bullishness, I think 80-20 is better. So basically on the weekly, first of all, during a Bitcoin bull run, the price should not close below the 20 MA. During a bull run, the 20 MA tends to hold a solid support, because if you look at the previous one, right, you see this, right? You see the previous bull run. Sure, the price wicked below it, right? But wicked does not mean close below it. Close below it, and right. Look, if you look at it, bull run started here, boom, 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 boom. It never closed below it. The only time it closed below it was here, and that's because the market changed from bull market to bear market on the cryptos, right? So that's one way to keep an eye. And the other way is that during a bull run, the RSI should not drop below 45. On the weekly, as you can see from the last bull run, the RSI continuously stayed above 45. In fact, it stayed above 50, so it shouldn't drop. The only time the RSI dropped below 50 or 45 was bear market, right? So keep an eye on RSI about 50. So the RSI on the weekly should stay above 50, at least 45 or more, and the price shouldn't close below MA20, because then that's a very bullish sign. And after correction, if you're asking where do you add positions for Bitcoin, right? Well, where do you want to add? So that's a good question. And if we switch on our EMAs, I tend to add, right, let's say Bitcoin's here, is right there, right, RSI is like 88, very super overbought, right? When do you add, right? I usually start adding when my initial position, when the Bitcoin hits the 50 MA, right, 50 EMA, which is the orange one right here, this orange one, because the top one's 20, then 50, then is 100, then is 200, right? So during a bull run, I add position when the Bitcoin is at 50 MA, when it hits 50, so which is here. Right, you see that hit 50 MA? That's where I start adding. Even if it drops to 100 MA, you can either set a stop loss, or if you trust the bull run and you have conviction, you just hold. You got to decide this for yourself. I'm not a financial advisor, but I usually just hold because I'm so bullish for the Bitcoin this year. Plus, I only add starter position if it hits 50 anyway, and then if it goes up from 50, then I add more. But if it goes down, then I'll add more when it gets to the 100. And during a bull run, the daily 200 MA should hold Bitcoin price up. If the Bitcoin price closes below the 200 MA, then the bullishness is arguably disappearing. The 200 MA tends to hold price of instrument up on the daily chart anyway. So 50 I add. So again, I added here. See, look how this price during this correction, it hit 50, which is if this is your 50 MA. I added more position there, and then I added a little bit more as I see it go up. I might if it drops below and more, then because there is a chance that there's a bigger correction coming imminently, especially when I look at the US markets, the VIX, where I can see the VIX, which is your volatility index for the S&P 500. I can see the VIX maybe drop to about here, which means when the VIX drop, your S&P 500 rises, right? So when the VIX drops to about here, which isn't that much more, I think the VIX will rise again, which means your S&P and stocks will fall. And when your S&P stocks falls, the Bitcoin price also tend to correct with it. So I expect a little bit more. I expect some more Bitcoin correction, pretty much imminent probably. I'm hoping there should be a few more days of bullishness in it. So I'll probably sell some more more partials along the way. So yeah, so these are some of the strategies. This is the strategy how you can add. You start adding when it hits 50 MA. If it goes to 100 MA, add more during a bull run anyway, and use these levels to judge when you should buy and sell. So let's say this is your correction. You start buying here at this candle. You then go and then once it gets to this next band, you maybe sell partial, and if it goes up before the next band, maybe sell more, and if it drops and then it goes up again. So basically just use these Fibonacci levels. If you buy after the correction and then sell at the first band level partial, sell at the second band partial, and or sell if the RSI is touching 80 or 75 because it's super overbought. So you know everything then fits together, and you can use that to judge your entries and exits, and you become a much more effective and profitable trader. Thank you guys, and thank you guys. Happy trading. Hey, welcome back. So that brings us to our final video, or final chapter of our lesson, which is purely on technical analysis, right? Everything technical analysis. You've learned somewhat 20 to 30 indicators based on technicals, whether it's for scalping or swinging. You've done all that, and you know how to do your entry timings, you know how to exit. So hope you found a lot of value in this course. So just to finish off with some patterns, right? Because usually these patterns, and there's a reason for these patterns, and each of these patterns is a psychological matter. The reason if these patterns form is because psychologically that's what's happening in the price and in the trading, in the psychology of the trader. So so some certain patterns just to go through. There's head and shoulders. There's sort of a channel bearish here, and channel bullish. This is a bullish flag, they call it. This is a bullish triangle, bearish triangle, triangle, triangle. Again, this is a bearish triangle pattern. And then you have double top, double bottom, head and shoulders, reverse head and shoulders, right? So these are sort of some of your common patterns, trading patterns, right? So just to show you on the chart, to be honest, out of these, my favorite is channel trading. In fact, I prefer channels that are sort of vertical channels or down channel, like this channel, like that kind of channel trading, or this kind of channel trading, or that kind of channel trading. I like those kind of channels. And I really, my favorite is probably the bull flag. I love bull flags like this. This is a bull flag, and this is a bull flag, right? I like those kind of patterns. And I'll just show you what I mean. I'll just show you on Bitcoin, for example, on the hourly chart, right? Let's just see. Let's see the daily. Here we go, right? So here's a typical bull flag pattern right here. This here, see, this goes up here, and this is a flag this way, and this one goes from here to here. Right, that's a bullish flag. That's a typical bullish flag pattern. So basically, the price goes up and comes down, correction, consolidates in a small range, and boom, explodes. Right, that's a typical bullish flag pattern. So again, here you can argue this is the next bullish flag. See, look here, this is the flag, right there. Without drawing it, you can see, and that's the next breakout. Right, I love trading those bullish flag patterns on a bullish instrument, such as Bitcoin or Tesla, or I'm sure. In fact, if we go to Tesla, I'm sure we can find. Or NEO, I'm sure we can find a bullish flag right there, right? See, without even looking any further, this one there, see this one here, there, that's a bullish flag breakout. That's your second bullish flag breakout, right? So there's two in a row, one there, two there, right? So yeah, I love trading those bullish flag breakouts because they're quite reliable, especially on a bullish instrument, because what's happening is that the price has gone parabolic. It reaches a super overbought range, it's got to correct, so the market corrects, market tries to go up and retest, then comes down, correct, and then it just consolidates. And because it's a bullish instrument, there's so much bullish momentum, traders then come in and take the price up higher. So I love those bullish flags. Again, trade them along with your RSI, with your trend lines and all that, right? And the channel trading that I've been saying, right, is this channel, right? Basically, you don't even need to draw the channel yourself. You just use the, I've already said this, just use the log trend line, right? It's called the logarithmic trend line indicator, right? Just put that on, logarithmic trend indicator, trend line, and then it comes up with this. So you can just trade off. So basically, when it reaches the bottom, touches the bottom, you long. You can even short when it's at the top and then it's super overbought. You could even short if you're confident, if you know what you're doing. But something like Bitcoin or NEO or something that's that super bullish, I might not short it unless if you know what you're doing and you're confident in the move, then do it, and don't be so greedy with the profits either. Otherwise, don't do it, just long it. So basically, whenever, so even if you go to TSLA, for example, even if you go to Tesla, so basically whenever the price touches the bottom channel, so you see how that's the channel trading, the channel I was talking to you about. So once the price touches the bottom, you would long it, and then you hold it until it touches middle or touches the top, depending on how you want to do it, or sell partials when it touches middle and then hold the rest. Again, if it touches the bottom, which is pretty much now, you buy long, and then again if it rises to the middle, you sell, right? So so that's channel trading, and that is also your bullish flag. So we've covered the bullish flag, we've covered channel trading, so that's great. Let's see what else we can find. Let's go to hourly. See what else we can find. Right, this right here, right, just right in front of me, you can arguably that is a head and shoulders, pattern, or a double top pattern, right? So basically, your double top pattern, if you go here, you see that there's your head and shoulders, and that's your double top right there. So if you actually look at this, so this is your left shoulder, this is your head, and this is your right shoulder. Or you can argue and say this is a double top, which is just a 1 and a 2, right? So that's the kind of double top. So basically what happens there is it goes up, price comes down, goes up, comes down, and it will end around about where this started. And that's your exact head and shoulders or double top pattern ending, and then you go the other way, right? Again, and if I'm being honest, personally, I don't actually trade head and shoulders pattern that much, especially shorting it, but I do use it to guide me in terms of profit taking. So for example, if I was in here, I ride this and I see this move and I see this move and I see it coming down, I would sell here for a profit, because then the head and shoulders or the double top pattern might complete, so it goes further down. There's no point in holding, you're already in profit, why not bag it instead of letting it drop? So that's the sort of time I would personally use a head and shoulders or double top, double bottom. Otherwise, this you could arguably say that's a double top or head and shoulders, so again, if it was like that, I might sell here, especially when is at the top channel. So here it goes up, right? I'll probably sell here instead of holding all this. Like, why do that when you're in profit? And then you can always buy back at a better price. So that's that. And also, just to finish off on patterns, there are also actually animal patterns. I see if it can, just type in animal trading patterns, right? There's like butterflies and sharks and all that stuff, and bats, right? If you look at this, right, there's animal patterns. So this is an animal pattern. This is a bearish butterfly, they call it, because price is here, and when it touches there, boom, it'll drop, right? And then you got bearish butterfly. You got bullish bears, you got bullish crab, right? So this is a bullish crab, it goes here, this buy here, it should go up. Again, these are sort of psychological patterns that traders trade with sometimes. And then you got this, which is a bearish crab, and you also got sharks as well. So just take a look at them yourself and see. And there's actually indicators out there that's called pattern detectors. You can buy them if you want. I can't remember now where you buy it from. I think, yeah, Indicator Vault, I think, if I remember correctly. Yeah, Indicator Vault. I used to I have quite a few indicator from Indicator Vault. If you're interested, you don't really need it. If I'm being honest with you, you don't need 100 indicators. You don't want to mess up you do not want to mess up your chart with more like 20 or 50 indicators. You don't need them all. Absolute maximum 10 is more than sufficient. In fact, even though I have 10 on, I usually have like some of them off, because then it gets messy and you can't really see the charts. Because at the end of the day, you want to see the chart, the pattern patterns and the price momentum and the price movement of the instrument as well. So I have a few on. I never really have more than 5 on at a time, and then the other 5 I switch around. You don't need 100 indicators because you can't trade with it. It's just too much. And also indicators, sometimes if you combine the wrong indicators, they go against each other and they give you mixed information and mixed signals, and then you might actually get confused, right? So you might want to just be careful with that side of things. But just to finish off, Indicator Vault, they actually have a indicator which is called pattern. Because we're talking about it now, I just wanted to show you. You don't really need it. You don't need to get it. But it's basically called a pattern, something pattern trading. There we go. There's that one, harmonic pattern indicator, right? If you get that, it costs about $10-20, whatever it is, and that will basically show you every. Basically, once you put it on the charts, it will show you every pattern that comes up, whether it's a shark, double top, double bottom, head and shoulders, flag, channel, or bat, butterfly, shark, whatever it is that actually shows you. It just comes up and shows you that pattern, and it draws it out for you. So in fact, I'll just show you harmonic pattern. If you click here, I'll just show you what it looks like. So look, see that it comes up on the chart just like that. For example, and then you can see exactly what pattern it is. You don't really need it. I actually have this indicator, but I don't personally really use it. You don't really need it to trade successfully, but I just wanted to draw your attention to it in case this is something you like. You can take a look yourself, and maybe you like it. So yeah, that's your pattern trading. And just to finish off the entire course, in fact, I'll do another video, one last video, next video, and I'll show you what kind of all the indicators that. Well, in fact, I've already showed you all the indicators, so you kind of know what's there. But personally, just you never really need 5 or 6 indicators at one given time. You don't need much. So, for example, the RSI or the Stochastic, these are really good indicators. Both together, used together, they're effective, along with the channels, along with the trend lines, along with the support resistance. On top of that, you might not need anything else, and you can switch some of the other stuff off. And then sometimes you can use your EMAs and switch that on. Then you can see your EMA. So it's up to you. You play with it and see what all of them, which ones fit you better. I pretty much usually I like this channel. I like the linear regression as well. I like, obviously, you have volume. You always have volume. Supertrend is quite good sometimes, but it does mess up the chart, so sometimes I have it off. And then I have the RSI Divergence and Stochastic MTM. Combine them, it's really effective. And the EMAs, of course, your major ones, now you know what they are. So that's it, guys. That's the end of the course. And I'm also going to include my Discord group link as a part of this course. Feel free to join that. Do watch that video on YouTube, which I'm going to include as well for the Discord group. You can follow alerts. Everything's free there. There's also one-on-one tutorials and one-on-one private sessions. And do check out my other courses, which I teach you how to, in addition to technical analysis, I show you all my fundamental analysis and sentiment analysis and how I trade exactly, how I check the news, how I use Webull, Finviz, Yahoo Finance, sometimes Motley Fool, just to get the overall view, and stock twits to get a view for your sentiment, and token metrics and all that. So everything's in my other courses, so do check them out. Thank you, guys, and happy trading, and sincerely hope you'll profit.
Hey guys, welcome back to the course. I hope you enjoyed the course so far, enjoying it. And so this is an update